To the European market open, everyone. A minute to go until the start of cash equity trading. I'm Francine Lacqua in London with Tom McKenzie.
And here are your top stories. Turning on the taps, crude tumbles as the White House weighs a massive release of reserves to battle rising gasoline prices. Russia offers oil to India at a steep discount. The US says President Putin has been misled about the war in Ukraine. Meanwhile, Germany says Russia is backing off demands for gas payments in rubles. Plus, Europe picks up the baton in the global bond sell-off driven by hotter than expected inflation data.
Now, this is what the futures are looking like, Tom. The focus, of course, on some of these futures is the rise DAX futures getting some 0.5%. If you look at oil dropping, as we understand that the White House is looking at releasing some extra stockpiles, so we'll see how it plays out throughout the day. But for the moment, Europe seems pretty stable.
Yeah, the linkages between the equity markets and the oil price, 180 million barrels is what's being considered in terms of that strategic release by the White House. President Biden seen speaking later today, so of course we'll be watching any comments and updates on that, whether indeed they do make that decision. Inflation and that data, we had the French data coming out earlier. We've had Germany, Spain and Italy all building the case for a more challenging environment and decision-making process for the ECB. The market's pulling forward their expectations of a move to 0% on the benchmark for the ECB to October from December. The gains here in Germany, DAX up 0.5%. The FTSE 100 gaining 0.2%. We had GDP data out for the quarter just an hour or so ago, 1.3% coming in a little above the surveys. The Spanish IBEX gaining 0.2%, and the French CAC 40 up 0.2 as well. 17 points for the French CAC 40 as we look ahead to the election season, of course, and that challenge for President Macron in April. Let's move it on and see how things are playing out then. Cross asset. We saw, of course, the pressure on the equities market for the US yesterday. The quarter, by the way, for this quarter, the worst quarter that we've seen since March of 2020. Of course, that's when the pandemic really got underway. But traditionally, April is a better month. This quarter that we're heading into is traditionally a better month, a better quarter. So we'll see whether indeed that plays out. But you're seeing losses for this quarter of around 6%, a little under 6%. Futures stateside pointed to gains of 0.3%. This is your 10-year yield, 2.33, just a move up of 1 basis point for the US 10-year. And the 2-year, the German 2-year, yes, so that was in focus, edged into positive territory for the first time for a number of years. It is currently just about in positive territory. The German 2-year remains in focus, of course, as we continue to watch the inflationary impacts across the Eurozone. And Brent, 109 per barrel, down 3.5% on the news out of the White House that they may be looking at the strategic reserve release in coordination as well with the IEA. Francine?
Yeah, 1 million is quite a lot, significant, and it would actually do also quite a lot to maybe temper a little bit inflation across the board, certainly for European producers. Now, this is the picture for sectors. If you look at the 20 sectors that make up the stock 600, energy down 1.5%, telecoms on the way down, but then we have auto parts gaining 1%, construction, travel, material, but also financial and media. And again, it just goes to this idea, Tom, that we're looking, of course, at the bond route, what happens here in Europe, and the focus is firmly on oil prices and the correlation between that and equities.
Some of the individual names that we're looking at.
Here.
Yeah, absolutely. Some of the individual names, H&M, in terms of the earnings story, what a grim set of earnings for this company. The retailer, of course, has exposure to Russia, has exposure to China. They're talking about the pandemic effects, not trading yet. We'll continue to watch this one, though. It came in at about 282 million kroner for the quarter. The estimates had been for above 1 billion, so a big miss there for H&M. I just looked on Taobao, by the way, to see if I could find any H&M products being sold on that e-commerce platform in China. Zero. It is still blocked in China. Losses there of more than 7.5%. By the way, you don't get a similar story for Adidas, Nike. They are all listed on that platform. ABB, the robotics and industrial company, gaining 1%. Adding to their share buyback program, so boosted the stock here today, just in the early stage of the trading. Brewin Dolphin, this is an RBC takeover cash deal that they are looking at, has been agreed, and at a more than 6% premium. So we'll see how that opens, and we'll continue to watch that stock for you. Let's get over now to Bloomberg MLive Managing Editor Mark Cudmore. And Mark, you, of course, laser focused on the oil story.
Absolutely, Tom. It's all I can talk about today and all I can look at. This is a chart of WTI over the last 10 years. I've used weekly chart to remove that weird negative print last year that really distorts the chart. The pink or purple line is the 5-year average. And as you can see, it was in a slow decline since 2014. That's when we really had the destruction of the shale industry in the US. There was this massive excess supply, and then OPEC did not cut their supply either. And we kind of really killed that industry in late 2014. There was a bit of a crisis, and now it's much stronger. Now, we're above $100 a barrel, and I think these are unsustainable levels, and I think the SPR release will have an impact. 180 million barrels is a large amount. I think the tactic of around $1 million per day over 180 days is a very interesting one, provides flexibility, allows them to adapt to the market a bit quicker. I think also important relative to the SPR releases last year is the timing of when this comes. We are seeing some signs, little signs of demand destruction. In China, we saw the PMIs this morning. We're talking about the lockdowns there. We know consumers are getting squeezed by inflation, and we are probably going to get a little bit more of a supply reaction. The other story that we're seeing is that perhaps Russian supply is not coming off the market so extremely. It's just being rerouted to Asia, for example, rather than some of the traditional buyers. Now, one more chart to show you quickly, because I really think this is the key part of this story, is the rig count in the US. I think many people argue that after the shale industry was killed in 2014, that it's not going to be able to take up the slack. A lot of the easy shale has been extracted. That is a reasonable view. There's a counter-argument, though, that they've become much, much more efficient. So therefore, yes, they are now focused on the bits where they can really get the most oil. They can get much more oil out of those drills. And they are still increasing supply overall. So I think the fact that this is a low rig count could actually be a bullish factor in terms that it can still rise much further rather than being a negative one. Personally, I think oil prices are unsustainable up here over the long term, but who knows for the next few days.
Mark, thank you so much. Mark Cudmore there, our managing editor. We're also catching up with Javier Blas, who's saying the main question is, of course, whether Vladimir Putin cuts off supplies, and it's not that easy for him to divert the flows further east. Now, President Joe Biden wants to take action on price increases at the pump. Bloomberg has learned that the U.S. is planning to tap into its oil reserves as inflation spirals and supply shortages loom due to Russia's invasion of Ukraine. Now, the administration could release as much as 180 million barrels over the course of several months. Now, for more on all of this, we're joined by Bloomberg's editor for energy and commodities, Andrew Janes. Andrew, first of all, how much does this release impact the prices in the short term, but the longer term legacies of this remain?
Hi, Francine. As Mark mentioned, this is a big release. It's 180 million barrels, which compares with a 50 million barrel release that the US did in November and a 30 million barrel release in March. And it's also going to be drip fed at 1 million barrels per day. So, I mean, we've seen a big drop in oil today, obviously. We were down about $7 a barrel at one point. Prices have come back a bit. We're now down about $5 a barrel. But yeah, this is undoubtedly going to have a big impact. Look, it's not enough to replace all the missing Russian oil out there. The other interesting thing about it is the timing. We may have an official announcement on this out of the White House later today, but it's coming on the same day that OPEC Plus has their regular monthly supply meeting. And of course, the backdrop to this is the US and others have become increasingly frustrated with the alliance over the last few months that it won't pump more. They wanted more late last year. When demand was rebounding fast from the pandemic. They wanted more after the war, but they haven't got it.
Andrew, one country that could be absorbing some of this Russian oil, India, and we know that Lavrov is in town in India at this point, putting pressure, no doubt, on them to absorb more of this cheap oil. What is the update there?
Well, it looks like Russia wants India to take at least 15 million barrels. There's a pre-existing contract between Rosneft and Indian Oil allowing it to take that much. It's rarely exercised. Russians are also offering that it'd be a rupee ruble transaction, and that they bypass the SWIFT system with a Russian bank messaging system. Important thing to note here is Indian oil refineries aren't really geared up to take a lot of Russian crude just because of the varieties. So in the short term, yeah, they can take some, but they probably can't take a huge amount of Russian oil.
Yeah, Andrew, that's really interesting. Really diverting the flows doesn't seem as straightforward as maybe some think. Thank you, Andrew Janes, our editor for Energy and Commodities in Singapore. Meanwhile, Tom, we're getting some price moves on shares.
Yeah, some major moves. Let's start with H&M then, because they came out with some earnings that were a very big disappointment. 282 million Swedish krona. The estimates had been for over $1 billion in the first quarter. This is pre-tax earnings. The stock falling almost 10% at one stage. As you can see, down 9.3%. They're blaming the pandemic, but of course they are also significantly closed out of the Chinese market, certainly on the e-commerce platforms. The H&M CEO just coming across with a line across the terminal now saying, regarding China, we're still very much in a complicated situation. We know, of course, this retailer also has exposure to Russia and Belarus. So the pressure on those shares for this retailer on the back of that big miss in earnings. The other big stock that we're looking at is a takeover, and we're looking at Brewin Dolphin. This is a all-cash offer by RBC. The premium was for above 60%. You're seeing that reflected in the share price jump today. Look at that, gains of more than 60% for the London-based money manager Brewin Dolphin. So just two stocks on the move today. Okay, let's get into the key market drivers then with our markets editor Christina Kino and Fabiana Fedeli, CIO of Equities and Multi-Assets at M&G. Let's start with you, Christine, and what we're seeing in terms of the read across from this decision. Hasn't been made yet by the Biden administration around the oil release, but what it may mean for equities. Certainly they seem to be getting a bid on the back of softer oil.
Absolutely, Tom. I think, on the surface of it, it does seem like a positive that the U.S. is taking steps to ease that cost of living squeeze that consumers are facing on the ground at the moment. Obviously, oil, spending on oil and energy, one of the big household spending sizes that consumers really face. And so at the margin, that does sound quite positive. I do wonder, though, longer term, how much will this really do to ease that inflation pressure on consumers? Because we know that it's really not just about the energy factor, right? We know that prices for goods, for food, for everything that consumers really care about, that's all rising. And we also know that cost of labor and the labor market in general in the U.S. is really quite hot. And so it may perhaps decrease the urgency, for instance, for the Federal Reserve to deliver those bumper 50 basis point rate hikes, but it may not completely turn that process around.
Fabiana, how do you see this? So between inflation, between some of the unknowns or known unknowns, including the possibility of stagflation, how do you build your ideal portfolio?
I'm concerned now. I'm concerned that markets are far too complacent about what is happening. If you look at the current scenario, there is a binary possible outcome. One is that the conflict persists, and obviously this is going to continue to push inflation up and potentially hurt demand, not only supply as it is at the moment. And this would end up in a recession. It's not only recession in Europe, but it's also recession outside of Europe at a global level. Of course, if the war resolves, we probably could see an improvement from a lowering of the price of commodities that have been pushed up so much by the war. However, that will also depend on how long the sanctions last and could have actually much longer standing impacts on the overall economy. And equity markets at the moment are really not pricing this in.
Okay, interesting. So Fabiana, they're highlighting the risk, the potential risk to demand. Christine, let's bring you back in then on the inflation prints we've had out across the Eurozone, well above expectations. And the challenge for the ECB, that meeting in April then for the central bank and Christine Lagarde, do we think that they're going to have their arms forced, their hands forced on this issue? They're going to have to act more aggressively to address this?
Well, Tom, there's certainly that risk for sure, and investors are gearing up for that meeting to be quite a big one in terms of the signal that we're going to get from the ECB. Already, in terms of ECB pricing, we've seen markets really bump up those expectations for rate hikes. They're now seeing about 100 basis points coming from the ECB in rate hikes over the next year. They've also slightly moved up their expectations for when that era of negative rates will end. We're now seeing it around October time, closer to October time rather than later in the year. And so, traders are really expecting the ECB to ramp up that policy normalization process. I'm not sure that the ECB will want to go as quickly as markets expect them to. And so that will be the key balancing act for Christine Lagarde and the rest of the committee.
Christine, thanks so much. Christine Aquino, there are markets editor Fabiana Fideli from M&G stays with us. Coming up, the U.S. says Russian President Vladimir Putin was misled by his military leaders about the war in Ukraine. Germany says the Kremlin is backing off demands for gas payments in rubles. So we have the latest developments on both those fronts. That's a little bit later on the program. And this is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
Well, as you point out, there are already very standard deviation away, semi-black swan events on things like inflation, not just in the US, but also in Europe. Of course, we've had also this major geopolitical shock, that is the war, and it's just a symptom of a much broader geopolitical depression. We are in a very difficult situation where extreme things are happening.
Nouriel Roubini, of course, who predicted the mortgage collapse that sparked the 2008 financial crisis, sees the world moving closer to a similar meltdown. Still with us is Fabiana Fideli from M&G. Fabiana, is Mr. Roubini overdoing it on the risks that face this economy and these equity markets?
I don't think so. He has always been quite bearish on markets and overall on the macroeconomic backdrop. But I think he has a point now. Inflationary pressures are high. We don't even think that the bond markets are really pricing them all in. Look at the five-year forwards. There is still room to have negative surprises. And obviously, central banks are walking a fine line here, and they might just stay behind the curve, which obviously doesn't help inflation. So there's a serious risk on the global economy, and not only in Europe and not only in the UK, but a much further risk.
Fabiana, you're very diplomatic. Also, the fact that Mr. Doom now could be close to calling it right should really make a lot of investors worry. Do you worry about stagflation? Is that your base case scenario? And if yes, does it mean a huge correction for all equities?
It's not a base case scenario, but it's clearly there is clearly a higher risk of it happening. So at the moment, when you look at equities, we just see markets being far too complacent. We see expensive valuations, particularly in some pockets of the markets. The truth is, if we are in a real recession, what generally happens is that equities will underperform other asset classes. Within equities, the markets that are perceived to be safer, such as the US, will do better, also helped by a stronger dollar, most likely as capital flows flow into dollar-related assets. But at the same time, right now, the U.S. market is at an all-time high in terms of valuations, and that makes the choice more difficult for equity investors.
So, Fabiana, how do you insulate your portfolio in this environment?
So if you look at our multi-asset portfolios, when I was on the program before the conflict, we talked about us taking some money off the table in equities, and putting some cash balances on the side, because we did expect some volatility in the market, not to this extent. We didn't know what was going to come, but we were hoping to deploy those cash balances. Right now, we are underweight equities in the multi-asset portfolios. We still keep those cash balances. We haven't deployed them yet. And we have been also short duration on the bond side, and we have been adding a little bit to that in the latest movement on yields. And within equities, we stay very diversified. We look at long-term themes, and we also make sure that we are very selective.
Fabiana, what's your favorite hedge right now? Crypto, gold, or something else?
It is very difficult at the moment, because you see how commodity prices have risen. That has definitely been the typical edge in this kind of scenario, but they have risen far too much, and they're probably more prone to coming down to some extent, maybe not all the way, but then continuing to rise. So really, diversification is at the moment the best hedge.
Thank you so much, Fabiana Fedeli, their Chief Investment Officer of Equities and Multi-Asset at M&G. Now, coming up, we'll get an update on how COVID is affecting the Chinese economy. Of course, this means also supply chain issues, ports closed down. That's coming up shortly, and this is Bloomberg.
biggest names in business choose Bloomberg?
That is a great question.
It's a great question. It's a great question. Great question. Great question.
Great question.
Great question. That's going to be the best question I get all night.
I'm glad you asked that.
Bloomberg Television. Top experts. Great questions.
Welcome back to the Open, everyone. 23 minutes into the European trading day, and you can see the stocks, Europe 600, holding on to gains for the DAX, getting some 0.7%. Now, stocks rising overall, oil dropping. This is on reports that the Biden administration is considering, of course, a massive release of crude from U.S. reserves to combat inflation, and that could do the trick, maybe at the margins, but certainly equities getting a bit of solace on that.
Another major story that's being eclipsed by what's happening with inflation, oil, and of course what's happening in Ukraine is the situation on the ground in China, particularly Shanghai, where there's a lockdown, and the economic data that looks miserable. China's COVID lockdowns putting the economy under strain and threatening to disrupt global supply chains. PMI for March showed lockdowns in key manufacturing and tech hubs cut factory activity, both falling into contraction. Let's bring in Chief Asia Economics Correspondent Enda Karan. Enda, the importance of the economic data, it's backward looking, but it already points to strains in the Chinese economy without even factoring in the lockdowns in Shanghai. Just map out for us how much strain is on the Chinese economy at this point.
I think, Tom, it does show now that the economy is under pressure. China is struggling with its worst outbreak since the pandemic began more than 2 years ago. And as you mentioned, the PMI numbers that we got for March that show both manufacturing and non-manufacturing going back into contraction territory, these numbers preceded the lockdown in Shanghai. The survey closed on March 25th. So what it did do is it captured the lockdowns in places like Shenzhen, for example. So obviously there was an impact to the technology sector, especially the tech companies in the manufacturing chain in that part of China, but it hasn't captured what's going on in the big finance hub that is Shanghai. So it's all pointing to more pressure on China's economy. It's certainly a test of this ongoing aggressive dynamic zero strategy that the authorities have in terms of trying to control the virus. We know that it's proving very difficult given the contagious aspect of Omicron. And I think most people seeing these numbers today say bad numbers for March, but worse likely still to come for April.
So does that mean, almost without a doubt, that we'll have to see the Chinese authorities step up on fiscal and monetary policy, Enda?
I think so, Francine. Again, remember the backdrop is a growth target of 5.5% that even Premier Li Keqiang himself said will be tough to meet. And now when you consider that growth target was set in December before China had any experience with Omicron, and we're seeing nothing but rolling disruption now in many parts of China since through much of February and March trying to battle this outbreak. So I think all the indications are that weighing on consumer sentiment, that's a complication for manufacturers. The manufacturing side of things is holding up somewhat. They're trying a bubble with a lot of these companies and these factories. They're trying to keep production on track. But you have to say that more official support will be needed, both government spending at provincial level on infrastructure, and of course the central bank will probably have to bring down interest rates. It all speaks to more policy divergence. The Fed going in one direction, but China's economy very definitely going in the opposite.
Yeah, it's pretty incredible, and actually more on the PMI report. So it dropped, and then you see construction, that sub-sector actually increasing. And as always, thank you so much for joining us, our Chief Asia Economics Correspondent joining us from Hong Kong. Now, coming up, we talk Europe's red-hot inflation issue. Of course, it's all about inflation. I mean, we had that print yesterday from Spain that was 9.8%. France, also worse than expected, but at around just over 5%, I think.
Yeah, a lot of it oil prices. Does that impact wages? We'll continue to keep across this. This is Bloomberg.
estudio, en nuestro experimento, no hemos pintado todos los edificios de blanco, sino estos más asequibles de pintar. Y ya hemos detectado reducciones medias en el área metropolitana de 0,8 grados aproximadamente en un periodo de ola de calor y con picos máximos de 4 grados de disminución en un momento puntual del día, en una zona puntual del día. Y como dices, en una ciudad como Barcelona funciona incluso mejor que las zonas verdes, según las modificaciones nos detectan incrementos, o sea, disminuciones de temperaturas mayores con tejados blancos que con incrementos de zonas verdes como tienen planteados el plan director urbanístico.
I think what we're seeing during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Welcome back to the Open, everyone. 30 minutes into the European trading day, and here are your top stories. Turning on the taps, crude tumbles as the White House weighs a massive release of reserves to battle rising gasoline prices. Russia offers oil to India at a steep discount. The U.S. says President Putin has been misled about the war in Ukraine. Meanwhile, Germany says Russia is backing off demands for gas payments in rubles. Plus, Europe picks up the baton in the global bond sell-off, driven by hotter-than-expected inflation data. So if you look at the markets, Tom, it's all, of course, about this release in stockpiles, what that could mean for the oil prices and inflation.
Yeah, the inflationary impact, as you say in the headlines, the bond market sell-off that we saw across the European space quite pronounced yesterday on the back of bets that the ECB is going to have to step up more aggressively. We're looking, of course, at the April meeting. And in terms of the quarter, it's the final day, of course, of this quarter. You were, in the previous parts of this quarter, looking at losses of up to 17%. Those have been paired. You're now looking at losses of around 5.6%. So still the worst quarter since March of 2020. But we will see if muted optimism around the conversations that continued between Ukraine and Russia can get us closer to some kind of ceasefire, and whether or not inflation starts to become less of concern. So far, inflation very much front and center. You're seeing that, of course, from the reaction of the White House with this plan on the oil reserves. You're seeing gains across the benchmark European stock 600 of 0.2%. Part of that is going to be down to softer oil prices, at least in the last 12 hours or so on the back of that news. We're waiting for President Biden to potentially outline those plans and articulate those plans and sign off on it later today. The DAX is gaining 0.6%, 87 points. The FTSE 100 up 0.1%. A couple of individual stories. H&M, very bad set of earnings. That's weighing on the retail sector, and we'll see how the sector by sector story plays out. And then within the financial sector, Brewin Dolphin and a takeover by RBC there, 60% premium or so, and that stock rallying. Let's switch it on and see how things are playing out sector by sector then. We'll have a look, of course, at basic resources on the back of softer oil and retail on the back of those H&N earnings. Immediate financial services topping the list, up 0.4%. Brewin Dolphin here in the UK will be playing into that story. At the bottom of the list, down almost 2%. Retail, again, H&M fell almost 10% on the back of those terrible earnings. The pandemic is what's being blamed, but of course they've been hit in China and they have exposure to Russia as well. Energy down 0.8%. That's how the sectors are breaking down. 30 minutes into your trading session this Thursday as we look to close out the quarter. Francine.
Now, Tom, the economic damage from the war in Ukraine is worsening across Europe. The continent grappling with already record inflation data that just keeps soaring. Hotter than expected CPI prints from Spain and Germany yesterday sparked a sell-off in short-dated notes in Europe, with two-year Bund yields among the most sensitive to changes in policy, briefly actually rising above zero for the first time since 2014. Well, joining us now is Benjamin Jones. He's Director of Macro Research at Invesco. Ben, good morning, first of all. Do you expect this to continue along this trend?
Good morning, Francine. Yes, I think so. Look, we've been surprised throughout the last, nearly year or so now with the inflation prints from Europe, and I don't see that changing. Excuse me, I don't see that changing at all today. I think certainly the Italian number we'll see relatively shortly will be just another surprise there. And look, a lot of it is coming from those supply side dynamics. So oil and food being the major driver at the moment. And it's very, very difficult to predict what is going to happen with oil on a day-to-day basis. So I think, yes, we will continue to see those surprises, and we'll continue to see upward pressure on inflation, certainly in the short term.
Ben, what are you seeing in terms of the data around demand, the hold up, the strength of demand, and at what extent and at what point that starts to be eroded by these very high inflationary pictures?
Yeah, I think that's the key question at the moment. So we know a lot of it is supply driven, fine, but we can't completely discount the demand side as well. I mean, we only really have to look at the import numbers in the US, for example, to see that there is still very, very strong demand there. And I think in the immediate term, that's going to hold up because we do still have consumers that are very flush with cash. There's a lot of cash on their balance sheets. They can continue to spend. And it's very difficult, I think, for the mentality of consumers to sort of back away from that spending. You get that kind of lifestyle creep. So I think it will take a little bit of time, and that means we won't sort of get the inflation coming down too quickly. My fear is that it sort of runs and runs and runs, and the Fed and the ECB have to start to try to tighten into this. They're not going to have an immediate effect. And then sometime in 2023, that's when it really starts to bite. Now, there are some... Sorry, Francine.
Ben, no, are they already behind the curve, the ECB?
I think probably a little bit behind the curve. Yep, I think both the Fed and the ECB probably should have gone a little bit earlier. Given the sort of expansionary fiscal policies that we had last year, I think that would have been a good time to start to tighten policy. Now, I think on a sort of temporal basis, I just don't think there's the sort of immediate pass-through from higher rates to starting to dampen some of those consumer sentiment and that consumer spending. So, yes, I think they probably should have gone earlier, and that means now they're going to have to go faster and harder, unfortunately.
The argument has been for some time that the wage picture in Europe is very different to the wage picture in the US. You don't have the stickiness. And I remember speaking to Jean-Claude Trichet, of course, the former head of the ECB, a couple of months ago, and he was making that point. Has that changed? Is that changing now?
I think you're starting to see glimmers of it changing. Certainly the Spanish numbers that we saw yesterday, you are getting some greater wage pressures creeping in there. I think you'll start to see it coming through in Germany with some of the negotiated wages being adjusted. So it takes a little bit more time, but I think there is signs that you are starting to get those wage pressures creeping in. You had, when was it, a week and a half, 2 weeks ago, then the Italian truckers strike as well, and that was very much around, look, we just can't make any money with oil prices at these kind of levels. So it all sort of feeds into the same thing, that the wages, the potentially wage pressure could creep up, and that's the thing to watch. I think if you do start to see wage pressures coming through in a significant way, that's what potentially can adjust those longer term inflation expectations.
But Ben, do you assume they'll have to? If you see these kind of inflation numbers, I mean, yesterday, when you look at Spain, the 9.8% was pretty stunning. Is it almost automatic that, you know, unless you want to lose your workers, you'll have to start paying them more?
I think you will, yeah. At some point, I think you absolutely will. I mean, given you've got a very tight labour market at the moment, workers do have options. So I think there is this shift. I think we will have to start to see those wages creeping up. It depends, I think, from a regional perspective as well, how much of some of these energy price rises can be offset by some of the fiscal measures. So transfer payments to various households, for example, may come through, and that can certainly, I think, alleviate a little bit of the pressure in the short term, but it doesn't change the longer term pressure. So yeah, no, I think wages are very much the key thing that we're watching in Europe at the moment.
Ben, what are the inflationary effects of additional fiscal spending on things like defence in Europe and support for the refugees, almost 4 million who've crossed the border from Ukraine?
Again, both inflationary in nature. We know from history, it's very clear that defence spending tends to be inflationary. We are going to get that coming through fairly significantly in Europe. And it's not just defence spending, it's infrastructure spending more broadly. Now, longer term, you could argue that perhaps that will be disinflationary or adds to sort of stability in prices if we move to more renewable energy sources, for example. But that's a long, long way down the road. That's certainly not going to do anything to to ease inflationary pressures in the short term. It's just going to go to add to those inflationary pressures. So, no, with all the fiscal spending plans and the increased fiscal spending plans that I think we're going to see in Europe this year, that again just puts extra additional sort of fiscal pressure in. And the same is true with the refugees as well. I mean, you could argue that, okay, we've got refugees coming into Europe, that perhaps ultimately eases some of the labour tightness that we just spoke about, because you've got, I think it's 4 million refugees have come in so far. But unfortunately, at the moment, most of those are women and children, and they don't immediately hit the workforce. I think, no, with the money that's going to them, that again is inflationary in the short term. So, no, 2022 is very much still going to be dominated by higher inflation prints, I think.
Okay, Benjamin Jones, Director of Macro Research at Invesco. Thank you for those insights, breaking down the inflation picture for us as we continue to get that data, or as at least we round out that data across the Eurozone. Back to a couple of the stock-specific stories, H&M and this terrible set of earnings for the first quarter. Just to recap for you, because the stock is down around 8%. So it's paired some of the heavier losses, at one point down 10%, this retailer, and this on the back of those first quarter results. So pre-tax profits coming in at 282 million Swedish krona. The estimates have been for more than 1 billion Swedish krona. They're blaming the pandemic, but of course we know they're impacted by the events in China as well. The CEO saying that the Chinese situation remains complicated, also blaming the pandemic as well. Another story that remains in focus today, stock specific, is Brewin Dolphin, a cash offer by RBC, an all-cash offer, RBC Wealth Management. The jump of 60%, 61%, in line with the premium that was being offered. You've been talking about M&A and how this could be a catalyst.
I did have to take a double take, though. 61% increase in a day, it's not huge. Now, M&A, of course, has swept through the wealth industry. Yeah. We were also having a chief executive yesterday to see whether, there's a danger of overpaying, but it's certainly, in tough times, you want to consolidate to be bigger, because that means you're more efficient in terms of research and things like that.
It's the kind of move you see in China. You don't see it very often on the FTSE 100, or at least on the London Stock Exchange. Coming up, the US says Russian President Vladimir Putin was misled by his military leaders about the war in Ukraine. Germany says the Kremlin is backing off demands for gas payments in rubles. We have the latest developments next. This is Bloomberg.
Stories about what they call black soot caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now. We are dying slowly but surely, and our lifespan is reducing every day.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Welcome back to the Open, everyone. We are 43 minutes into the European trading day. We're holding on to gains. The DAX gaining 0.4%. Global stocks, if you look at what we've seen so far, still on track for their worst quarter in 2 years, amid concerns, of course, about growth slowdown and amid concerns about higher inflation with the war in Ukraine driving volatility in commodity markets. Today, maybe a little bit of reprieve because oil is dropping on the reports that the Biden administration could be considering this massive release of crude stockpiles. So Hungary goes to the polls on April 3rd, that's Sunday. The Prime Minister Viktor Orban faces the biggest test to his rule. Opposition parties are uniting in an attempt to oust him. The European Union is also threatening to withhold funds over Hungary's rule of law issues. Now, of course, the war in bordering Ukraine has negatively affected the economy. Let's get straight to our reporter, Maria Tadeo, who's in Budapest for us. Maria, great to have you there on the ground. How is the war actually upending Orban's campaign to stay in power?
Well, Francine, we've talked about this realignment triggered by the war in Ukraine and the actions of Vladimir Putin, and this is a place that really shows you just the contradictions that this government is facing. When you look at Central and Eastern Europe, Hungary is the odd one out. Hungary has said under Viktor Orban's directions, and he's made this very clear, that it wants to stay neutral in this war, that it won't act as a distribution hub for weapons into Ukraine. And he's also said repeatedly that he does not support and is not in favor of an energy embargo from Russia. A lot of this reflecting the relationship that Orban himself has with Vladimir Putin. Remember, he was one of the last Western leaders to go into Moscow, have a very friendly discussion with Vladimir Putin. He said that sanctions would be counterproductive, that Russia is still a great power in the world, and therefore you need to have a constructive relationship. But when you look at some of the neighboring countries, particularly Poland, and remember, normally Hungary and Poland are very connected in their policies. Well, right now it's the complete opposite picture. The Polish being very hawkish on Russia, and then of course Hungary finding itself in a very awkward position when it comes to its neighbors. But again, Francine, a lot of this, as I said, reflecting the very own contradictions of Viktor Orban at this point.
We always get brought back to the gas and energy story, Maria, and of course you were speaking to the German finance minister about this question, about the question of paying in rubles, and it now seems like the Russians are backing off. Was this just a bluff, do you think? What do we know at this point?
Well, Tom, we'll have to wait and see, because if you look at the record in this war, where it doesn't play well for Russia, Russia has said many times we are going to do A, and in the reality, you get B. But if you look at the briefing in that call between Chancellor Scholz and President Vladimir Putin, the Germans have briefed us yesterday here, said that the Russian leader indicated that there would be no changes, that the contracts that are stipulated in euros for Russian gas can continue to operate as normal. They would get paid into Gazprom's bank, and then after, it's up to Russia to decide whether or not they want to change that and convert that into rubles. Now, when you look at the Kremlin readout, however, for the time being, they only said there's an ongoing technical discussion about the new payments that Vladimir Putin is demanding. But nonetheless, Tom, if you strip away from the details here, many critics, particularly in Brussels, will tell you it changes nothing. The reality is, in many ways, the European Union and some of its biggest economies like Germany are continuing to finance this war because they continue to pay gas for Russia. So at this point is this debate around should we ban energy imports or not, and the Germans have not switched positions. They still say they don't want to do this, could turn their economy into recession.
Maria, thank you so much. Maria Tadeo, they're on the ground talking for us about multiple fronts. Now let's get straight to the Bloomberg First Word News with Laura Wright. Hi, Laura.
Hi, Francine. The U.S. is said to be weighing a large release of oil to combat soaring inflation. Bloomberg has learned the Biden administration is exploring a release of roughly 1 million barrels of oil a day from reserves over a period of several months, adding up to as much as 180 million barrels. The plans are accompanied by a diplomatic push for the IEA to coordinate a global release by other countries. The US claims to have intelligence suggesting Vladimir Putin is being misinformed over the war in Ukraine. According to the White House, advisors to the Russian president are said to be afraid to tell him the truth about the performance of his military.
We believe that Putin is being misinformed by his advisors about how badly the Russian military is performing and how the Russian economy is being crippled by sanctions because his senior advisors are too afraid to tell him the truth.
Apple and Meta platforms provided customer data to hackers masquerading as law enforcement officials, responding to forged emergency data requests in mid-2021. The companies supplied details such as customers' addresses, phone numbers, and IP addresses. Asked to comment, Apple referred Bloomberg to a section of its law enforcement guidelines. Jamie Dimon has received almost $56 million of JP Morgan stock from an incentive program that the company valued at less than half that much just 3 years ago. The bank's CEO collected the shares last week from a performance award dating to January 2019. The windfall, higher than last year's payment, was helped by the financial industry's surging business during the pandemic. Global news 24 hours a day on air and at Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. This is Bloomberg Tom Francine.
Laura, thanks so much. Laura Wright here with the First Word News. Now, coming up, more from our interview with the Ryanair Chief Executive, Michael O'Leary. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. There are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
The industry is still recovering from the COVID pandemic, so there appears to be a huge pent-up demand, particularly from families, for travel all over Europe this summer. We believe that peak summer travel months, June, July, August, September, will be very strong. But there's no doubt that the wider economic, the wider health of the economy will be damaged by these very high oil prices. And so, the sooner or the earlier the war in Ukraine can be brought to a conclusion, and the sooner the energy price or that stability return to energy markets, the better for not just consumers, for the airlines as an industry in general, but for the wider European economy as well.
Right. Yeah, Michael, I don't want to belabor the point, but I do wonder if it impacts the consumer, if you still have this 20% that's unhedged, which of course is very low and better than most of the industry. Is there a level of oil that you're looking at, be it $150 or higher, that if sustained, it would actually start to impact margins and consumer demand?
We don't think so in the near term. I mean, we still believe that this summer will be strong. I think if oil prices remain high, where we think that things will get a bit scary will be next winter. You'll have rising energy demand coming into the winter period. European economies will be somewhat undermined by, either higher oil prices or concerns over energy supply, and that may, we may be looking at undermining consumer confidence or the risk of a recession. So, again, I can come back to the point. We think the summer will be strong. We are well hedged in Ryanair, and if there is a concern over consumer spending, it generally tends to favour the low-cost airlines in Europe, like Ryanair and others. And so I would expect that we will continue to grow strongly. But as an industry, we need a resolution of the Ukrainian situation, and we need more stable energy prices.
And that was Ryanair CEO Michael O'Leary speaking to Bloomberg Daybreak anchor Danny Berger on pent-up demand for travel and the aviation industry. Ryanair currently trading up 3.2%. A couple of other individual corporates we want to draw your attention to. H&M and a grim set of first quarter earnings pressuring the stock there. They're blaming the pandemic, but we know, of course, they face particular hurdles in the Chinese market. They also have exposure to Russia. They have said, the CEO, they're going to have to pass on some price increases as well as a result of inflationary impacts. The stock down 8.2%. Brewin Dolphin, the money manager based here in London. This is an all-cash offer by RBC Wealth Management. The premium around 61%, and you can see that the share price jump this morning reflects that premium being offered by RBC Wealth Management. Apple is another interesting story, Francine. This hack.
Many stories. I mean, the hack
a number of stories.
Incredible.
You've got the chip stuff, they've got the move into the financial sector, and then the hack.
And so the hack, I'm once again actually really into the hacking stories, because this is not really hacking as you'd expect people to go in. It's basically what they forged documents saying we need your legal data, and it's a bunch of kids in London.
Yeah, they think it might be teenagers in London. They haven't named anyone or found anyone, but they think it may be and may lie in the UK, some teenager in their basement in Slough or something doing this. But Apple, of course, has prided itself on being focused on security, and then they react to this attempt to portray themselves as law enforcement officers, hand over some personal data. They are also, on the other front, they did it, and Meta did as well.
I mean, sometimes it's really the most simple hack that works the best.
Well, that's what they say, right? Change your password, make sure you're updating it. They're also on the chip front looking to add a supplier, potentially from China, and then building out their financial services. So you saw Goldman actually falling in the back of that news because they have that partnership.
So is that, if you look for more suppliers, is it diversifying, or it's just trying to make sure they have China on side?
So, wow, good question, given the size and importance of that market for them. They produce, of course, the bulk of their smartphones in China, but getting the Chinese government on side is something that Apple have been very effective at in the last, in the years, in previous years.
I think this is after what a key Japanese partner just wasn't able to deliver.
Yeah, so it's about building additional suppliers and diversifying as well, Francine.
Diversifying, always good. That's it for European Market Open. We'll diversify into surveillance early edition. That's coming up next. We'll look at your markets. We also have a great French election special. We talk to chief executives about what they're hoping for the next government. This is Bloomberg.
Companies now, they're getting hundreds, maybe even thousands of applications. So software has come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Well, good morning, everyone, and welcome to France. Bloomberg France Decides, the Chief Executive Officer briefing. I'm Francine Lacqua here in London, and here's what's coming up on today's program. France's CPI figure hits 5.1% to another record. The war in Ukraine stokes inflation across Europe. The cost of living becomes a top concern for French voters. Macron feels a heat. The incumbent's lead narrows. His main rivals pledge more radical steps to aid households. And stay with Bloomberg TV, because joining us today to discuss all of this, the French state election, well, Stéphanie von Courtin, the MEP for Macron's La République En Marche, the chief executive for the manufacturer Saint-Gobain, Benoît Bazin, and the so-called queen of French tech, that is the Station F director, Roxane Varzan. If you have any questions for any of our guests, please, IB plus TV Go. Now, first thing is first, let's check in on the markets, because it is also the end of the quarter. So we focus on politics, we look at France, and of course that inflation debate, without forgetting what's going on in the wider market. The focus firmly not only on oil, but also equity markets. European Stoxx 600, you can see pretty much flat. So the S&P futures on the way up, but not as much as they were 10 minutes ago. So I wouldn't call it a reversal, but certainly stocks a little bit on the cautious side after there have been these reports that the Biden administration is considering a massive release of crude from U.S. reserves to combat inflation. And you can see, I guess, that's stoking a little bit of optimism that inflation will be a tamer. Then we see what happens in terms of earnings, which is why European stocks pretty much unchanged. So this year's presidential election presents a crowded field of candidates. Let's take a closer look at the main contenders in France. First up, the centrist incumbent, Emmanuel Macron, polls place the 44-year-old president as favorite to win the election, though with a tighter margin than back in 2017. His lead over contenders has been shrinking over the last few months. The far-right Rassemblement National candidate, Marine Le Pen, has been tipped to face Macron in the final round like she did in 2017. However, she continues to face the challenge of changing her party's xenophobic image and confronting her past links to Vladimir Putin. On the opposite end of the spectrum, we have the left's main candidate, Jean-Luc Mélenchon, a staunch critic of Macron's economic policies. The 70-year-old is polling in third place, but still a long way off the almost 20% of the vote that he received back in 2017. Valérie Pécresse is the center-right candidate for Les Républicains, initially seen as Macron's main threat. A faltering campaign so far has seen her slip in the polls. In the past, she described herself as two-thirds Angela Merkel and one-third Margaret Thatcher. And finally, another contender for the right-wing vote is Éric Zemmour. The far-right challenger burst onto the political scene in 2021 after he shook up the campaign with his immigration zero rhetoric. Now, for a look at the polls, the President Macron's lead has narrowed. That's according to the latest polling average calculated by Bloomberg. The gap between him and second-place Le Pen is down to 7.3% percentage points, while the other candidates vie for third place. Now, the main concern of French voters is, of course, spending. The cost of living tops concerns, with many in France feeling their purchasing power has deteriorated in the last few years. Now, we're joined now by Stéphanie Courtin, Benoît Bazin, and Roxane Varzan. So thank you all for joining us. We're going to have about half an hour to really debate some of the policies and what you want to see from the next government. Benoît Bazin, let's start off with you, because you're in charge of a fairly big company. You deal with supply chains. You deal with a lot of the inflation figures coming in. What do you need from the next government of France?
Chief Executive Officer of Saint-Gobain, we are always planning long term. So for me, what is very important in times like the ones we live in France and in Europe today is to invest for the future. So it's investment on innovation. We need to go towards energy transition, decarbonation of buildings, huge energy efficiency needs to decarbonize buildings. So investment on innovation, investment on education. We need new skills for the next 10 years to deal with digital, with new materials, with new competencies to deliver on the plan for France 2030. We need also a very strong framework in Europe. So we need absolutely to continue to invest and lead in Europe as an overall framework in which the companies, the citizens can live and grow. We need, of course, an energy policy which is strong and which will overcome the crisis of today. So for me, what is important is to project the country in the future like we are doing as a corporation for the next 10 years. So invest on the future, and my main ask would be Europe, innovation and education.
Thank you so much, Benoit. Stephanie, Benoit laid out, some of the concerns. What do you think this election will be actually voted on? Given the war in Ukraine, tendencies people want, stability and actually look for comfort. If there wasn't a war in Ukraine, is it the cost of living? Is it actually something else that people worry about in France? Is it immigration, or is it really the living standards?
Well, as you highly mentioned it, good morning. As you highly already raised the issue of the cost of living concern, which definitely is the top priority of the people in France. I just wanted to mention that as French president so far, over the last 5 years, Emmanuel Macron has achieved a very great deal of success and of reforms, despite the 3 major crises and the third one, which is the war in Ukraine. I just wanted to flag that I think Emmanuel Macron, and will continue to do that, has definitely changed the philosophy of France under his 5-year term. Our country has become, I think, more pro-business. He has given kind of a capitalist culture by creating an ecosystem favorable to companies and foreign investments, be able to project in the long run, as it has already been said, with this France 2030. It has been able to also to make the labor market more flexible, bring visibility and stability to entrepreneurs. So I think this is important. But at the same time, it definitely...
Yeah, and it is important, which is why you're seeing him actually play quite well on the economy, which we'll get to in a second. But he's failed in terms of pension reforms. That's something that to keep in mind. So I don't know what happens if he gets reelected to that. And he's also struggled in dealing with the Yellow Vest movement.
Well, yeah, I mean, every president in France has to struggle with many protests. In France, that's the rule, and so of course there are many concerns when it comes to purchasing power of people, and this has become one of the key concerns during this election, and it will be also one major step to take within the next following years. When it comes to the Yellow Vest protest, I mean, I think he has definitely tried to change things and to help people. When you look at the statistics, I mean, he has achieved one of the main objectives he had in 2017, which was to lower the unemployment rate, and this promise has been delivered. So of course, and you mentioned the war in Ukraine. I mean, he faced so many crises that he couldn't deliver all the reforms he planned to. That's why we need five years more.
Yeah, Stephanie, and you have a very interesting perspective because, of course, you are from La République En Marche, so Emmanuel Macron's party, but you're also one of the few French MEPs with direct impact on drafting some of the Digital Market Act position for the European Parliament. Roxane, tell me a little bit about what you need. So if you look at startup funding in France, they've actually increased quite a lot in the first half of 2021. Do you still see that money flowing into France? Is Stephanie right that now from outside investors, France is...
I think we have seen, especially in terms of innovation and company creation, I think it's been at a record high and it just keeps increasing year over year. Stephanie mentioned unemployment at an all-time 15-year low. I mean, I think these are elements that we definitely need to continue. And then from a startup perspective, I think there has been so much that has been accomplished that we need continuity, we need stability. And I think that this is a president that has understood this population, the needs of the young companies very, very well. From the other candidates, we see attempts, but nothing anywhere near what President Macron has accomplished and the understanding that he has.
Benoit, talk to me a little bit about exactly what you see a second term for President Macron delivering in terms of, I don't know whether it's more reforms, I don't know whether it's just subsidies because we're still in a war and we just need to fix the cost of living. I know you were mentioning as a CEO what you wanted. What do you think his number one priority in a second term should be?
I think we have seen a great deal of improvement on the labor market. For instance, a big achievement in France is the apprenticeship. Last year alone, we hired 5,800 new employees in France, half of them being below 26 years old. So this labor market is more fluid. The attractiveness of industry, we have changed, also turned around the image of industry. We need industry. This government has pushed a positive image of industry. Going forward, we need to accelerate, as I said, the investment on innovation, because we have a lot of technological disruption ahead of us. We need to invest on education. We need, third, to also continue to make reforms on the governance of the country. In a world which is changing extremely fast on geopolitics, on digital, on technology, we need a governance which is very fluid, very agile. This is what we are doing when we are heading corporates like Saint-Gobain. So I think the competitiveness of the country, it's not only the taxes, the attractiveness of jobs, which has changed again in France, but also the governance to make it agile and fluid. So for me, accelerating on innovation investment, accelerating on education, from schools to universities, and third, continue the reform to make agile governance, fast decisions, down to the ground, close to the businesses, close to the people. Agile governance will help France accelerate in the 21st century.
Right. Benoit, how are you dealing with energy inflation? Do you have to pay actually your people more? And how worried are you about supply disruptions being accelerated because of COVID in China?
Well, this is something we have faced over the last 2 years. Indeed, a lot of supply chain disruption. It's true in France. It's true also in the US. Last year alone, we had 260 cases of force majeure, suppliers shutting down in North America. So it's true around the world. We have created within Saint-Gobain a very local, agile organization where our managers on the ground take very fast decisions and they overcome every single crisis. So this year is another challenge because of the war in Ukraine. We have to overcome that. Yes, we have to cope with higher inflation, and we are going to live in a world with higher inflation. We have to pass that in the salary. Salary increases are 1.5% higher than they used to be. Same on the pricing to customers. So this is the new world we are living in, and we have to adjust, adapt. We have done that remarkably. We at Saint-Gobain last year, we had the best year ever. Why? Because we are driven by energy efficiency on buildings. I think President Macron has understood that the best way to decarbonize France, to achieve carbon neutrality by 2050, is to tackle the carbon emissions from buildings. They make 30–40% of the CO2 emissions. We have the levers at Saint-Gobain to decarbonize that. And President Macron has already decided to accelerate and support more investment on energy efficiency for buildings, aligned with the Fit for 55 policy coming from the EU. So that's a lot of initiatives I think that we should see in the coming 5 years.
I mean, I'm trying to get someone to say something bad about this current government. Stephanie, talk to me a little bit about debt. So, of course, I know we're going from crisis to crisis. We had COVID for 2 years. Now we're looking at the war in Ukraine. Do you worry about debt levels in France? So debt has been rising in all European countries just because of the fiscal nature of what we had to do to support them. At what point should maybe France and other European countries look at austerity?
Yeah, well, I think time now is to tackle the crisis, you know, and you remember that when Emmanuel Macron and his government spoke about this whatever it cost approach, many people laughed and accused him of raising the debt level even more higher. But you may remember that some weeks ago, Paul Krugman, which is the well-known Nobel Prize in economy, just applauded and said this approach was a risk that definitely paid off, and it was really the right choice to keep the economy strong through the challenge of crisis. So I think, yes, there is a risk of debt rise, but I mean, right now, we need to tackle the crisis. I mean, the pandemic is not over, and the war in Ukraine is still ahead of us, in addition to what Benoit said, I mean, the twin transition. And fighting against the global warming is not just a catchphrase, you know. There is the concrete outcome which has just been adopted through the carbon border adjustment mechanism regulation by the Council on the 15th of March, and it's a major step. You know, it's definitely a carbon levy, just a major step to step up the decarbonization, as well as to you know, put more equality in our industry. So I think this is key. And talking about the twin transitions, which are, as Roxana and as Benoit said, you know, climate and digital. Even if the war in Ukraine is hiding a lot of news, we've done a major step also on tackling the GAFAM and the big techs by regulating them ex ante. We've just reached an agreement with us, the European Parliament, the Council, and the Commission, which is just unprecedented.
Thank you, Stephanie. I also want to talk. Yeah. So let me talk also about specifically the tech sector, Roxane. I know you touched on it, but when the newly elected Macron said in 2017, I want to be France, to be a startup nation, his detractors mocked him. But if anything, France was struggling to attract venture capital, like in both the UK and Germany in 2016. Now French startups, as we were saying, are pulling in record funds. Now the promise of digital tech has really played a growing role in the French economy, leading to an explosion in cybersecurity attacks. Now last month, the new cyber campus opened its doors with private companies, public bodies, and government departments joining forces to spearhead France's new cyber strategy. So when you look, Roxane, as some of the things, I guess the seeds that have been planted, what exactly does France need to make sure that some of these startups are then fully hedged fund, fully funded companies? Can we have the next Facebook, maybe, or the next Meta, the next Google in Europe and specifically France?
Completely, and I think that is actually one of the goals that he set forward. I mean, France's initial goal was to have 25 unicorn companies by 2025. That goal was actually hit 3 years early at the beginning of January. And so the new goal is now to actually create the next European tech leader by 2030. And so I think that's actually a goal that's kind of been outlined, and a lot of companies are probably on track already to hit that goal. But in terms of what we've seen, I mean, we have definitely seen record levels of funding, record levels of companies being created. I think a lot of it has been the president himself and what the government has done, but I also think we need to put it in a context of the, geopolitical context with, what's happening in some of the other more traditional leading ecosystems. Silicon Valley got insanely expensive. We also had Brexit in the UK. So, you know, a lot of places that entrepreneurs would traditionally go, they started looking elsewhere. And I think it was at that key moment that France really started to rise to the forefront. I would say another thing that has started to happen, but that we definitely need reinforced and continued would be with regards to everything that welcomes international investment and international talent into France. And that's obviously a very touchy subject, but that is what's really going to help us create those leading international companies of tomorrow.
Yeah, and Alexandre, is there always a danger that actually the more international money there is, the more President Macron is going to be attacked on that, on the fact that it's not French enough? That's actually, there's still an underlying, you know, socialist currents that runs through that, for example, for an American investor is very difficult to grapple. And so what comes after Macron? We need to start thinking about that now.
Exactly. I think it's a very thin line to walk. But if we look at the tech sector, if we look at these young companies that are scaling fast and want to go international quickly, that is exactly what they need.
Saint-Gobain and the chief executive, Benoit Bazin, still with us. Benoit, how do you see the next government being formed? So I know it's very difficult, but you're in the thick of things. As a chief executive, what kind of prime minister do you think the new government could benefit? What kind of pivots could mean that some of the reforms laid in place, which all three of you seem to like, can really be accelerated?
No, as a CEO, I prefer to stay away from those political discussions because I still have a lot of job to manage my own team, so I would be cautious on that. No, what is important is the ability to push reforms. As I say, you know, we still have a rather complex public governance in France with multi-layers of administration, whether it's in the departments, in the regions, at the national stage. So I think the ability to reach a kind of consensus on a broad base and therefore deliver on the needed reforms as fast as we need, I think that would be, for me, a key criteria of any government going forward. The ability to be large, the ability to gather strong momentum so that we can deliver reforms which are needed quite fast. So that's, for me, my main ask, I would say, for the next years.
Benoit, you have a very interesting company because, of course, you produce glass, insulation, you know, high-performance ceramics, plastics, abrasives. How much of a nightmare actually is the supply chain right now? Because freight costs are so much more expensive because certain ports in China and elsewhere are closed, and also a lot of these materials, I imagine, come from the Ukraine region.
No, actually, we have changed the organization of Saint-Gobain 3 years ago to make it local, country by country. We are tackling 90% of our business is on construction market. They are local by nature, and we have local plans with local customers and local managers. 90% of our country CEOs, we are organized by country. They are native from the countries. So for us, we don't have a large supply chain coming from Asia to Europe. This is in North America for North America, in Argentina for Argentina, in France for France. And for instance, you know, we decided a few weeks ago, this shows also the confidence we have in France to invest 120 million euros of capex for new insulation materials for the coming years, because there is a boom in terms of needs for that, but we take decisions locally. So this local governance, we are multi-local organization, has made it very robust to fight the COVID, which was country by country, to fight the supply chain disruption of last year and even this year, and to fight, of course, any geopolitical issue going forward. So it's a very robust country-based organization.
Okay, I also want to spend a bit more time on inflation. Thank you for that, Benoit. Now, with the cost of living the chief concern to French voters, today's latest figures make grim reading. Now, we did talk about this a little bit with our guests. French inflation accelerating more than expected to reach another record. Prices rising 5.1% from a year ago in March, the most since the data series began in 1997. That the outlook actually is not much better. Households' expectations for future price increases have hit the highest level since records began back in 1972. Price struggles have plagued Macron's presidency, with gas taxes actually sparking a prominent and persistent yellow vest process. So, Stephanie, when you look at some of the challenges in terms of inflation, how do you think a second presidency for Emmanuel Macron, and I don't know whether you would go as far as saying as this is now a given, just looking at the polls and the system in France. Will he, be a different president? What kind of team will he surround himself with? And will he be a braver president, or actually is it more difficult? Are we going to see many more reforms in the next 5 years?
Yeah, well, I do echo what Roxana and Benoit just said on the fact that we need to push for more reforms. And as I said previously, the three major crises, the Yellow Vest, the pandemic, and the war in Ukraine have prevented that. We should welcome the economic rebound following the COVID, and the EU has come back to, I think, a pre-crisis in record time. And France has been leading the pack. I think we should, as you said, be very attentive to the inflation, and inflation levels are, of course, very high, and the impact is magnified by the war in Ukraine provoked by Russia. But of course, and I'm sure that Emmanuel Macron will carry on pushing for reform. There is a strong ability, a strong willingness from the start to do that, and I think the pension reform is one of the major project and initiative we'd like to take as soon as he can, provided he's elected again, he's re-elected.
So we only have 3 minutes left, so I'm going to ask each of you actually the same question. Stéphanie, if we start off with you, if you look at Macron's biggest dream, which is more European integration, if he gets re-elected, which again, the polls really seem to suggest that is the main possibility, will he manage to get more European countries behind to push for integration?
Yeah, well, I think he has already been committed to Europe in a very realistic and pragmatic approach, and he will still carry on building this new model of economic prosperity based on green, digital, and inclusive growth. And he will push for that within Europe, and since leading this role as the President of Europe for 6 years.
Okay, Benoit, in 20 seconds, do you think he'll manage? Thank you, Stéphanie. Benoit?
Yes, I was in Poland in the last 2 days. There is a great hope from Poland, from all Europe, to have more Europe in the coming years for peace, for energy policy. So yes, the new president, whoever it is, and Macron has been leading Europe for the last months as head of Europe. We need to lead Europe. This is the future. We need to be confident for innovation, for competencies, and for skills. We are strong in Europe. We need to be proud of that.
Thank you. Benoit Bazin, Roxane Varza, and Stéphanie Yvon Courtin. We'll have plenty more, of course, on France Decides shortly. This is Bloomberg.
Energy prices and a short supply of key chemicals that produce synthetic fertilizers are sending pig, cow and horse manure prices soaring. Even human waste is in demand as farmers hunt for alternatives. Fertilizer helps increase crop yields.
You can see how much moisture is held into this. It's a lot of organic material into the compost, so it breaks down. The manure and the straw breaks down into a friable mix that can be mixed into your soil in the ground and for growing a whole range of different vegetables. Holds the nutrients in, holds the water in, and it really increases the kind of biodynamic profile of the soil.
The recent price spike could mean more farmers going organic for the long term.
Lots happening on Wall Street.
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
We need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Wherever you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web, this is Bloomberg.
Turning on the taps, crude tumbles as the White House weighs a massive release of reserves to battle rising gasoline prices, while Russia offers oil to India at a steep discount. The U.S. says President Putin has been misled about the war in Ukraine. Meanwhile, Germany says Russia is backing off demands for gas payments in rubles. Plus, turning to Beijing, Apple is said to be exploring new memory chip suppliers, including potentially its first from China. Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, this is a picture for the markets. A lot of focus on that stockpile reserve release that we hear the Biden administration is looking at. So European stocks, they did start off the day on a high. Now they're pretty much unchanged, if not a bit lower. Now, oil is still falling. Stocks are a little bit mixed. Investors, again, weighing reports from the Biden administration about this massive release of crude, but also they're weighing concerns about surging inflation. I know we talk about it every day, and it seems that the market really hasn't made up its mind. It'll be up to central banks either to assuage them or actually to say, look, they're being a lot more hawkish. We'll see because of this rise in inflation. So President Joe Biden wants to take action on price increases at the pump. Bloomberg has learned that the U.S. is planning to tap into its oil reserves as inflation spirals and supply shortages loom due to Russia's invasion of Ukraine. The administration could release as much as 180 million barrels over the course of several months. Well, joining us now to discuss all of this, Helen Robertson, our energy and commodities editor in London. Helen, thank you for joining us. So first of all, this is a huge amount of releases. What would it do in the short term in terms of oil prices?
In the short term, it's likely that it would bring down prices, but over the longer term, looking at the global picture, obviously what really matters is the course of action that OPEC Plus takes. Yeah. And of course, we have a meeting later today, likely to be a key one. What we're expecting is that the group will ratify in effect, pre-existing deal to increase output by just a modest amount. We've heard sort of over the past few days that key OPEC Plus members have come out very much in support of Russia in terms of its strategic importance within the group. They've said very clearly they want to keep global geopolitics out of oil market supply decisions. So we'll see what happens.
So Helen, is it dangerous if you release so many stockpiles now? I mean, you have to replenish them. If you try and do that in the winter months, could it actually be a mistake? So short-term relief in terms of inflation or oil prices, but then longer term we suffer.
Of course, and obviously this is an absolutely key thing that President Biden's got to balance at the moment. Obviously bringing down inflation, keeping sort of consumers at the pump happy. As we know, gasoline prices have hit unprecedented levels for US consumers. Obviously an issue of incredible political importance, well, to them and obviously to the White House. And then obviously balancing that with global supply issues. As we know, President Biden has appealed directly to OPEC Plus in recent months, urging
so
them,
far, though, they're like,
exactly,
sure, talk to the hand.
Exactly. He's made a direct appeal urging them to release additional supplies, and it's not had much success.
Helen, I mean, because I know you have some reporting to do, and actually we look at, what this means for the markets. We heard from Goldman Sachs, we heard from Oanda, we heard from Clearview Energy Partners about how they see this playing out. But would this be coordinated? Because that feels pretty crucial. So would it just be the U.S. or would it be with the IEA and others?
I don't think we have those details at the moment. I mean, we believe that a decision on whether this will actually happen could be made as soon as today. We know that obviously the IEA has been in discussions with its members over a coordinated stockpile release. But I think so much hinges on the decision that OPEC Plus makes today and then what we hear later on from the White House.
Yeah, it's just the numbers are quite big that it really means, you know, if they go through with it, it means that they mean business. One person from Clearview saying it's hard to overstate the scale of this intervention if it bears out. Helen, thank you so much. Helen Robertson there from our energy and commodities team here in London. So JP Morgan does not see a global recession 2022, but sees tighter monetary policy, the war in Ukraine, and lingering inflation putting the brakes on global growth. The asset manager expects supply constraints to keep inflation elevated and central banks to lean hawkish. Well, we're now joined by John Bilton, head of global multi-asset strategy at JP Morgan Asset Management. John, I don't know where to start. I have like 1,000,001 questions, really hard questions. First of all, I mean, the stockpile, the numbers are huge. Could it be, if not a policy mistake, could it be, you know, a political message to Putin to say, like, look, we got this, but at the end of the day, could it backfire?
In terms of the oil release, look, I think that the US consumer is concerned going into what the Americans call driving season about pump prices. There's no doubt it's more to do with that, I would argue. There's a sticker shock when you see gasoline at $4 and north a barrel. But actually, if we look at the facts, it's super interesting. If you take the real price of gasoline and you look backwards, actually gasoline at the pump in real terms is slightly less expensive than it was immediately following the financial crisis. Electricity prices are lower. Natural gas prices to American households are lower. Yes, they're moving upwards, make no mistake, but the share of disposable income spent on energy in the US is hovering only around 3.5% today.
John, how do you explain the freak out? Is it because we haven't seen any inflation for 3-4 years that we actually just don't really know how to deal with it? And by we, I mean markets, I mean investors and central banks.
Well, again, let's look at how we got to where we are. We've had supply shocks that have been brought about by not just the crisis and the war in Ukraine, but have been brought about previously by the aftermath to COVID. So that huge supply disruption takes a while to work through the system. But secondly, remember, unlike the 2010s, we've had monetary and fiscal stimulus together, not just pushing on a string, but giving it a good hard yank as well. And of course, that's created this upward pressure on prices. We've got tight labour markets in the US. The Fed have to respond to this inflationary threat. And what do markets want? Why are they not taking it too negatively in stock market terms? I would argue because we want to see a credible central bank. Central bank, Jay Powell and his team have got the memo now, and they are pushing ahead to address this otherwise threatening issue.
What does a credible central bank look like? So is it front-loading? Is it 50 basis points? And is there going to be a communication concern? Because 50 basis points, does it mean that they're panicking? And what happens the next time around?
No, not at all. I mean, I think it's what they're doing is they're responding to the conditions that they see, which is the right thing to do. We've now got 225 basis points of hikes priced in for this year. That's a significant amount of upside to the Fed funds rate. It's worth noting, everyone's talking a lot about yield curves, about 2s, 10s. The Fed care a lot more about 3-month, 2-year, because that's demonstrating that the Fed have been, yes, behind the curve, some would argue, responding to risks to the macroeconomy, others might argue. The fact is that they now recognise the need to tighten policy conditions within the US, and that, of course, is what's led us to the point where we've got the steepest front end of the curve that we've seen in many years. 2 standard deviations in 3-month, 2-year, compared to the long-run history.
Tom Keene sent me that chart. You sound like Tom Keene, John. We'll have you back.
I'll wear a bow tie next time.
Yes, maybe red with a couple of dollar signs. When you look at what that means overall for the risk of stagflation, are we there yet? And is there a danger that, again, the Fed actually focuses so much on inflation that they forget about growth?
Well, look, let's make no mistake. When the Fed tighten monetary conditions, it carries with it a threat that it will eventually lead to a destruction in demand. And the reality is, if we look at the last 9 recessions in the US, only 2 were caused by overzealous tightening. There can be many reasons for recession. I would challenge the word stagflation. What we're seeing is a world where growth is reasonable. Maybe it's a bit more sluggish than before. Stagflation requires stagnation and inflation. We've got sluggish growth and inflation. Maybe it's slugflation.
Slugflation. How do you deal with stagflation? in Europe. We thought that the situation here, and again, I know it's a supply shock, people saying, look, the ECB could not have predicted these huge swings, but is there a danger that policy means tightening and then actually, reversing that very quickly?
Well, I think within Europe, we've got a number of other cross currents. So if we look at Europe, we are more reliant on gas from Ukraine and Russia, and that creates that supply issue for energy. We also have a significant industrial base. And as a result, what that means is impacts from raw materials prices. So there is a reason to think that Europe is perhaps going to have a little bit more of a tough time in the middle part of this year. But make no mistake, the ECB raising rates to zero actually is a bonus to the banking segment. And bear in mind, if we actually look into European employment data, there's a lot more slack within the system there. So the clear and present risk through labour markets is less pronounced in Europe. The ECB have more latitude, we feel, to plot a reasonable path.
All right, John, thank you so much. Inventing the word slugflation and at the same time wearing a bow tie next time. So he's definitely coming back. In fact, John Bilton is so good, head of global multi-asset strategy at JP Morgan Asset Management, that he's coming up after the break as well. The president of Ukraine, Mr. Zelensky, having gone to many parliaments or speaking to parliaments, starting with the U.S. Congress last week, now speak to the Dutch parliament. So we'll get plenty more on those headlines as they break. Now let's get straight to the Bloomberg First Word News with Leanne Gerrans. Hi, Leanne.
Hi, Francine, and thank you. The U.S. claims to have intelligence suggesting Vladimir Putin has been misinformed over the war in Ukraine. According to the White House, advisors to the Russian president are said to be afraid to tell him the truth about the performance of his military.
We believe that Putin is being misinformed by his advisors about how badly the Russian military is performing and how the Russian economy is being crippled by sanctions because his senior advisors are too afraid to tell him the truth.
Now, Germany says that Russia is backing off its demand for gas payments in rubles, according to a German readout of a call between President Putin and Chancellor Olaf Scholz. The Russian leader says European buyers could continue paying for gas in euros. The comments appear to be a de-escalation from Moscow after the G7 refused to agree to the move. Now, the US and Australia have criticized India for considering a proposal from Moscow that would undermine sanctions imposed by America and its allies. This as Foreign Minister Sergei Lavrov travels to Delhi for talks. Separately, Bloomberg understands Russia is offering India discounts of as much as $35 a barrel on crude oil. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Coming up, the U.S. says Russian President Vladimir Putin was misled by his military leaders about the war in Ukraine. Our Leanne was also saying the same thing. Germany says the Kremlin is backing off demands for gas payments in rubles. So we'll have the latest developments, of course, on Russia next. This is Bloomberg.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Germany says President Putin is backing off his demand that Berlin pays for Russian gas in rubles. And the White House, meanwhile, is saying that Putin was misinformed by his advisors on the war in Ukraine. Now, let's get straight to our European correspondent, Maria Tadeu, who's in Budapest. Maria, of course, you're in Budapest, also ahead of the elections. And the link between Budapest, or certainly Viktor Orban, and Russia is something that we need to talk about. But first of all, is the clampdown from Putin over his ruble payment demands to Europe real?
Well, Francine, we'll have to wait and see. But if you look at what the Germans briefed yesterday after the call between the Chancellor and President Putin, is that nothing will change in those contracts, that European nations will continue to pay for Russian gas in Europe. So then after that, the Gazprom bank can decide what it wants to do with it, keep it in euros or convert it to rubles. But this is not a change in the mandate of the contracts. And that was a main takeaway from the Germans yesterday. They also said that Chancellor Scholz asked Vladimir Putin for a document in writing so he can take a look at the details of this new rubles for gas demand. Now, when you look at what the Russians said, however, it was very little detail, and they just said the talks continue about this new payment system that Vladimir Putin wants. But for the time being, and to answer your question, yes, the euro payments continue. You could argue for some that is a sign of relief, but fundamentally, Francine, if you take a step back from this, it doesn't really address the issue. Whether you pay euros or rubles, you're paying Russia for gas, and critics will tell you ultimately this is financing a war that's now on day 36.
Yeah. Maria, at the same time, Viktor Orban's ties to Putin, of course, are adding to a lot of, well, adding not only to the stakes, but also questions about the upcoming election. What does this all mean for Europe?
Well, Francine, you know, we've talked about the big realignments we've seen already in Europe as a result of the war in Ukraine, when it comes to defense, when it comes to military spending. And now here, particularly in Central and Eastern Europe, there's a big political realignment. Usually, you know this very well, Poland, the Czech Republic, Slovenia, Hungary, they all work together, they lobby together, they carry similar policies. But this time around, Hungary is the odd one out. It looks very different to its neighbors. It says it wants to keep the country neutral. It does not want to be a hub for weapons distribution. And Viktor Orban continues to say he would not be in favor of a full energy embargo from Russia. We know he has a personal friendship with Vladimir Putin. He was one of the last Western leaders to go to Moscow before the invasion happened. And he says a lot of this is counterproductive. The one thing I would also say, Francine, on a personal note, yesterday I was very surprised that in Budapest you're still able to watch Russian TV. I looked at it in my hotel. Remember, in Europe, the satellite pictures have been taken off TV. And when you look at Hungarian TV, excuse me, they talk about a conflict, not so much a war, but a conflict in which the two sides have provoked each other.
Maria, thanks so much for all the reporting on the ground. Maria Tadeu there in Budapest. Now we're back with John Bilton, head of global multi-asset strategy at JP Morgan Asset Management. John, I guess the main concern is that markets either have a short memory, or there are also, a lot of young folks that are working in the markets that don't even remember when interest rates were high, that haven't really had to deal with any of these geopolitical crises. What are the odds of something going wrong? We don't really talk about China that much in our markets, but actually there's also a huge shift in that part of the world that will reverberate here.
I think that's true. I mean, look, I think we should give credit to the fact that there's still a decent amount of grey hair. I sport some myself around dealing floors in the city.
No, you're young. Too young still.
But remember, we saw a rate hiking cycle from 2015 to 2018. So it's not like the markets are naive.
A little bit.
Could something go wrong? Of course, something can always go wrong. But at the end of the day, we're dealing with a situation where the economic outlook has shifted. We've not dealt with combined monetary and fiscal stimulus before, and the knock-on effect on inflation. So, in many regards, central banking is the perfect example of learning by doing. And to be fair, I think responding to the data in front of them is what they're doing today. May they have to go further? May they push the US into a more tight set of conditions? It's possible, but I think it would be also important not to get over-focused on that today. Okay. That's a problem for down the line. Now, China, as you mentioned, super interesting situation. I mean, emerging markets underperformed developed markets, largely led by China over the past year or so by about 30%. It's a significant valuation discount across parts of the Chinese equity market, but at the same time, we've got the cross-current of rising COVID cases and question marks about supply chain.
So, John, will they have to actually put more fiscal and monetary stimulus, and do you play that divergence?
I think that there's an argument that that China are more likely than pretty much any other major bloc to be able to stimulate their economy in one way, shape, or form. And so if folks are worried about the fact that you've got tightening conditions elsewhere, loosening conditions in China could be a reason to start to be looking at it. Personally, when I look at, for instance, the Chinese tech sector, it feels like there's a lot of it being buffeted around by news flow. And that's the hallmarks of a market that's putting in a bottom. So I do wonder whether we need to be watching China and EM more broadly quite closely for when we may get an opportunity to be able to rotate back towards it.
March 31st, end of a quarter, what's your boldest call right now?
Well, I think given all of the talk about 2s, 10s, and could we be slipping into contraction, I actually think credit markets look really pretty resilient. Corporate balance sheets are in great shape, and I really do think that unlike previous cycles where you see 2 10s flatten and then credit kind of doesn't do so well, I actually think credit could be the surprise performer.
John, thank you so much, as always, for coming on. John Bilton there, Head of Global Multi-Asset Strategy at JP Morgan Asset Management. Now, coming up, we'll have plenty more on technology and diversifying chips. Apple looks to expand its roster of memory chip suppliers, including considering a Chinese maker for the first time. We also talk about a hack. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Apple looking to diversify its supply chain for memory chips. That's after production disruption at a key Japanese partner exposed the risks of its global supply. Now, for more, we're joined by Bloomberg's Alex Webb. Alex, I have a million questions about Apple because there's also a hack which may involve teenagers in London. But on this supply, I guess divergence or the fact that they're changing, why go after a Chinese supplier?
Well, I guess they always want to have as many sources as possible, not least because it lets them play suppliers off against one another. China is interesting because China, we think of iPhones being made there, but actually it's really just assembly that happens in China. The actual kind of guts of the thing get made elsewhere and imported. China's been trying to build its chip industry up. Memory is kind of the lowest spec part of that. It's a really commoditized piece. It's not the brains of the device.
So Apple also considering an in-house financial payment system. On the back of that, I think some of the big financials in the U.S., Wall Street, that were involved in that have been falling.
Yeah, and the thing is that is actually something that when the refresh rate, the pace at which people get new iPhones is slowing. It's now 3 years maybe. And they expect maybe if there's not a big upgrade in the years ahead, that's going to extend even further. This is a way of eking more margin out of the customers that you have.
But bottom line, does it mean that they're betting big on China and they want to be friendlier to China?
Yeah, it's certainly, if they go for this Chinese supplier, they are forging a closer relationship to it. And, that helps China when it's making the case in the US that there shouldn't be trade sanctions.
Alex, hacking the old way. So this is not like sophisticated hacking. This is pretending to be law enforcement and hacking Meta and Apple.
The most vulnerable part in any company when it comes to hacking is humans, right? The actual systems are often quite waterproof, but human error is often the biggest problem. This was, as the reporting suspects, it's sort of a group of teenagers kicking up a storm.
In London, right?
Potentially, or in Oxford, I think.
Yeah.
That is not perhaps as dangerous, maybe. It's easier to say for me. I'm not the person who's been hacked, but it's not as dangerous as sort of a nation-state level hack, for instance.
But so they would have called, allegedly, they would have called and pretended to be law enforcement and say, I need all this data.
Exactly, submitted paperwork which essentially spoofs what law enforcement officials would have submitted. Usually this requires sign-off from a judge, but there is a mechanism where something is super urgent, say there's a terrorist attack, then you can get around some of those controls.
Alex, I don't know whether that's comforting or not. I mean, what does it mean? That it seems so dumb that you would give it that way.
I mean, look, the moment you give your data to anyone, even if you trust that person, that you're leaving it out of your control. And so that's always going to be the risk. Nothing is 100% secure.
Alex, thank you so much. As always, with some great insight, of course, on some of these technology stocks. Now we'll have plenty more on Apple. We'll also have plenty more on the markets. So we're seeing a bit of a reversal when it comes to European stocks. They were gaining. Now they're a lot lower than they were about 10 minutes ago. So let's bring it up. You can see European stocks down some 0.1%. The focus will be on the price of oil. It's very clear that energy stocks are now falling with oil on reports that the Biden administration is considering a massive release of crude from U.S. reserves to fight inflation. Bloomberg Surveillance Early Edition continues in the next hour with Matt Miller, Katie Lyons in New York, and Anna Edwards here in London. This is Bloomberg.
We know that it's highly transmissible. We know that 2 doses of vaccines, Pfizer vaccine specifically, neutralize the virus, but not as efficiently, because various studies showing that reduction up to 40-fold, meaning that a 3rd dose is a must for it to successfully neutralize the variant. What we don't know is still that what are the effects of mix and matching between vaccines, and what are the capabilities of antibodies produced from this mix and matching in neutralizing Omicron. Because as we know, many parts of the world use different types of vaccines. And that would be a great data to look at. It will be also great to look at, because majority of the studies done uses a small sample number, and most of the time when you translate it to real world, the data changes. So it will be really good to look at large-scale data of the ability of antibodies from vaccines to neutralize this variant. Grateful here today that the virus, Omicron variant, still uses ACE2 receptor as its main entry. It means that all of the vaccines which are designed with spike in mind still works. Imagine if it uses a different receptor other than ACE2. None of the vaccines would work today. So I think that is the best news that we got from all these studies which came recently, the past couple of days.
Stocked early enough all these precious materials you were just mentioning, and we were on the lucky side that our prognosis was spot on in a way, forecasting what kind of material we would need and what quantity we would need.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's going to be a sloppy, choppy, messy year.
The downside risks are so great at the moment.
In the longer run, and I don't mean years, I mean a month or so, I think the oil markets will basically recover in terms of supply side.
We have one objective only, which is trying to maintain the supply to the market and ensure that that supply is affordable.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kaylee Lines.
It's 10 a.m. in London, 5 a.m. in New York, and 5 p.m. in Hong Kong on this Thursday, March 31st. Our top stories today. The Biden administration is considering a massive release of oil from U.S. reserves to fight inflation. 1 million barrels a day could be released for months. OPEC Plus isn't expected to help much. The cartel and its allies are expected to rebuff calls to pump even more oil. And in France, inflation is running faster than expected. Consumer prices rose 5.1% in March from a year ago. The ramp up in inflation across Europe is putting pressure on the ECB to consider raising interest rates. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Lisa Abramowitz and Kaylee Lines in New York. Matt Miller is off today. And Kaylee, those expectations or that pressure on the ECB still many months away, it seems, in terms of raising rates across the Eurozone. But the pressure on oil prices, from oil prices, is lessened a little bit today by what we've heard from the US.
Yeah, potentially a massive reserve release coming down the line from the U.S. Also, Anna, happy last day of the first quarter. It has felt like a very, very long one. And it is a quarter that ended on a downbeat note in Asia overnight. The MSCI Asia Pacific Index was lower by about 0.8%. Now, in part, sentiment was weighed down by weaker manufacturing PMI data out of China, once again in contraction territory. And that was even before the Shanghai lockdown we've seen put into place this week. Really signals the issue the Chinese economy has with its COVID-0 policy. The other drag in Asia overnight was Chinese tech stocks. The Hang Seng Tech Index falling about 1.4% after SEC chairman here in the U.S., Gary Gensler, threw some cold water on the speculation that a deal was close on those 200 Chinese companies listed here in the U.S. being able to stay on exchanges. Still a lot of questions around the outcome of those auditing rules. I also wanted to point to what's going on in Japan, because you are seeing that unprecedented intervention by the BOJ continuing to make a difference in the bond market, specifically at the long end of the curve. That 30-year yield coming in 8 basis points overnight. We're sitting just south of 94 basis points. Meanwhile, the Japanese yen is stronger again today. 121.10 is where it trades against the dollar, Lisa.
Well, I will say that today, definitely the focus in the United States all about the prospective 180 million barrel release of oil from the strategic petroleum reserves that the Biden administration announced yesterday. That is coloring all of the action in pricing. You are seeing a little bit of a lift in S&P futures, and this comes in the heels of a bit of a suppression in the bond space. How much does this actually relieve pressure on the Federal Reserve to raise rates as quickly if the inflation from the commodity impulse isn't rising as quickly? 10-year yields 2.327%. Crude, you can see that decline, nearly 6% decline at one point, now down 5.2% on the NYMEX. How much are we looking at something that could potentially actually bolster the U.S. economy? How much is that what's sort of edifying the dollar at a time when there still are significant concerns about stagflation in Europe? And Anna, when we talk about Europe and those inflation numbers, the sell-off in the bond market there has just been astronomical, really raising questions of how much further it has to go.
Yeah, absolutely. A big focus on that bond market selling from a European perspective over recent days. This is the stock market picture, Lisa, and you said that the S&P was getting a little bit of a boost. Futures were getting a bit of a boost from that down move in oil prices. Well, that was the case here in Europe at the start of our trading day, but that move has faded a little bit now, and you see European equity markets a little undecided in which way to go, actually moving slightly to the downside on some of the large continental European markets. We just had Italian inflation data out, and it does play into the narrative of higher inflation because 7% is a high inflation rate, of course, by historic standards. But it does make a change to see an inflation print coming in just below estimates. The estimate was for 7.2, but not much below as those numbers speak for themselves. The euro, 111.28. Lisa was talking about dollar strength there. Brent crude then, just keeping an eye on where we are on this oil story then. Lisa pointing to that big move in WTI. Substantial move also in Brent crude, down by 4.3%. This was in the early part of the session. Well, it continues to weigh on oil prices, and it was pushing aviation stocks higher here in Europe. It continues to do that to some degree, and we see the likes of Wizz Air up by 3%. H&M down by more than 9%. The clothing retailer, really some cautious wording coming around from this business. They don't declare exactly their exposure to Russia, but it was a really big growth market for the business. It was apparently really profitable for the business. They've had to close those stores, and so growth is not going to be increasing as fast as it was, and that is a bit of a hit to this business. Talking of Russia, let me show you where we are on some Russian assets. We've seen ongoing normalization steps coming through, if you like, in Russian stocks. It's not a normal market by any stretch yet, but we have seen the reintroduction of short selling for local investors. Foreign investors are not able to even sell stocks right now, but so as a result, we don't have an exact picture of Russian stocks, but we have seen quite a substantial rebound from the start of the invasion, 4.7% to the upside in just, or moving higher, sorry, in just today's session. This is the Russian currency moving higher as well. The dollar down, the ruble up by 2.3%. Interesting to see that commentary, Kaylee, from the Germans saying that President Putin has stepped back a little from calling, or the Russians have stepped back from calling for ruble payments for energy products. The Russians have a slightly different take on things, but that's the German story. That's what they are suggesting has taken place.
Yeah, Anna, and of course we'll have more on that energy story, specifically on natural gas later on this hour. But later on today, it really will be all about oil. OPEC Plus is meeting virtually to discuss its next course of action, not expected to stray from its course of modest production hikes. Then New York Fed President John Williams will be making opening remarks at a conference on the future of New York City, hosted by his bank later on. Blue Origin also will be flying 6 people into suborbital space on the company's 4th crewed mission. And finally, in geopolitics, Russian Foreign Minister Sergei Lavrov will arrive in India for a 2-day visit, Lisa.
I will say that everyone's watching to see what the tit for tat is actually going to be if there's a material pullback from Russians in Ukraine. Meanwhile, really the focus, as we've been saying for the bulk of this morning, is on oil. The Biden administration weighing a massive release of oil. We're talking 180 million barrels potentially from the reserves. Bloomberg has learned about this and the perspective for President Biden to speak and talk about what this will do in terms of the price of gas. Jack Fitzpatrick covering it all from Bloomberg Government down in D.C. Give us a sense, Jack, of what we expect to hear from President Biden later today.
Well, they haven't announced exactly what the details of this are going to be. He's supposed to talk at 1:30 about energy issues, but our colleagues have spoken to people familiar with these discussions who have reported that the conversations are around about 1 million barrels per day being released from the Strategic Petroleum Reserve that could total up to about 180 million barrels total. That is a historic release if that's what they decide to do. It obviously doesn't address the structural issues around gas prices and all of that, but considering the fact that there are some estimates that globally consumption could outpace supply by, or production rather, in the second quarter by about 800,000, it could make a very significant difference in making up that gap. It's not the kind of thing that would replenish any thinning reserves, but this would be a very significant thing from the U.S. Keep in mind they have about 568 million barrels available in that reserve. Maximum drawdown capacity is about 4.4 million a day. It's not as if they're taking everything out of it, but this would be a massive, massive release of oil from that reserve from a historic perspective from the U.S.
Well, and obviously, Jack, the need to get more oil in the market exacerbated by the supply challenge coming from Russia and the sanctions put in place on it. While discussing Russia, we of course heard from the U.S. yesterday as well that intelligence suggests that Putin is feeling misled by those closest to him. What can you tell us about that?
Yeah, they've said that the Russian President Vladimir Putin did not get particularly good advice about his military's capability. Some of this may be stating the obvious a little bit, considering the way Russian officials talked about not even a full-scale war, but sort of somewhat of a military operation in Ukraine. Clearly, there was an expectation that this would not be so dragged out, that whatever would happen much more quickly. The U.S. officials have not detailed exactly who misled whom and where the origin of this was, but the White House communication director spoke to that a bit yesterday, saying that the Russian president did feel misled about exactly what their capabilities were, and clearly this is not the way Russia expected things to pan out in Ukraine.
Jack, thanks very much. Jack Fitzpatrick of Bloomberg Government joining us there from Washington. Now, Jack was talking there about what's been happening with oil and the politics in the United States. Oil has dropped in response, dropping sharply on signs that the Biden administration is considering this big release of crude from U.S. reserves. The news comes ahead of an OPEC Plus meeting today. Let's get more on the oil markets then with Bloomberg's Danny Berger. Danny, thinking about the SPR then, that's clearly putting downside pressure on oil prices.
It is. We are looking at oil dropping around 5% in the U.S. WTI. It had been even deeper of losses since then, but it's come back slightly. Look, I think few would deny that the short-term implications of this are huge. Jack was describing the size there, so I won't rehash all of it, but it does help to ease some of these short-term supply pressures. Further down the road, that gets a little bit murky considering the structural deficiencies in this oil market. And one thing that Jim Bianco points out that I think is really smart, this idea of what it means for the SPR going forward. Inventories pulled down to the 180 million barrels that our estimate would take this to a 40-year low. This is supposed to be an emergency reserve, so at some point, they're going to have to fill the coffers back up, so the market just might down the road price in another buyer, which in turn pushes the price of oil up.
All right, Danny, this is all on the U.S. side. What about OPEC Plus? Do they feel any pressure at all to change their course today?
Well, if anything, this eases the pressure for them to change their course. Little expectations were out there that they would increase the quota that they'd already agreed on some months back, the 400,000 barrels a day. And of course, oil looking a lot cheaper today. And look, they haven't even met those quotas, and we're likely to see even less Russia oil online in the coming months. OPEC has shown little appetite to support Washington to the detriment of Moscow. And of course, oil diplomacy, Kaylee, it's a long-term gain, and if there are even indeed concerns of recession, undersupply could quickly turn to oversupply in this oil market.
Yeah, have to factor in demand as well. Thank you so much to Bloomberg's Danny Berger. Now, Ukraine says talks with Russia are set to resume on Friday, that's tomorrow, via video conference, after in-person talks in Turkey this week did not produce a ceasefire or major progress toward a broader peace deal. Let's go to our Maria Tadeo, our European correspondent, who is joining us from Budapest. So, Maria, are we seeing any signs of how far from a real de-escalation we are in this war?
Well, no, and if you look at what President Zelensky said overnight yesterday is that in many ways that convoy moving away from Kyiv just reflects that this was a fortress city. It had been locked and sealed by the Ukrainian capitals, and the Russians in many ways could not have taken the city. They also feel that a lot of the deployments could be moving to the east around the Donbas area. Remember, that has been the big concern for the Ukrainian government. The Russian troops are essentially trying to split the country in two. That's, of course, for the action on the ground. When it comes to the talks, we know there will be a video conference, but experience, especially when you look back at the previous rounds here, tell you that those video conferences usually do not produce anything. It's the meetings face-to-face that take the conversation forward. So in many ways, we're back to how we were on Monday.
Maria, amid all of this backdrop and the potential for talks, you're in Budapest, you're in Hungary. Why?
Well, look, there's an election happening here. Of course, Viktor Orban, if you don't know him, he's been in power already for 12 years. This is someone that I'm sure in America you would know him because he was a supporter of President Trump. This is someone who speaks very highly of Christian values, family values, traditional values. And that was the topic of conversation going into the election. But the problem is, of course, this is a country that now neighbors Ukraine. And Hungary now finds itself in a very awkward position. We've talked about the political realignment as a result of the invasion from Russia into Ukraine. Well, we're seeing that play out here. This is a country that carries now a foreign policy that some argue is too neutral, perhaps, or too friendly to Russia. Is a complete opposite of what neighbors are doing in Poland, Slovakia, and so on. He says he doesn't want to see an energy embargo from Russian energy. He doesn't want to deliver weapons into Ukraine. And of course, he keeps repeating this is a conflict in which Hungary has to stay out. And just very briefly, to me, it really caught my attention yesterday when I arrived in Budapest and I turned on the TV that I could actually watch Russian TV. Remember, in the rest of the European Union, most places in Europe, the satellite signal has been taken down, quote, because it's a propaganda machine. Well, that's not a problem in Budapest.
It's a war of information as well. Thank you so much to Maria Tadeo, our European correspondent from a beautiful and rainy Budapest. Now let's get back to the markets and take a look at some stocks moving in pre-market trading here in the U.S. A big mover to the downside is UiPath. This is the robotics automation software company, gave a light revenue forecast overnight. Analysts cutting their price targets as a result, and the price of that stock is moving lower in early hours, trading around $24.80, down nearly 15%. I also want to get a check on Apple. Of course, it snapped its longest winning streak since 2003 yesterday. This morning, those shares moving back to the upside by about 0.4% or so. Bloomberg reporting overnight that the company is looking for new suppliers for its memory chips for its iPhones, potentially even looking at a Chinese producer. So really trying to diversify that supply chain. And speaking of production happening in China, I wanted to point to Tesla as well, because according to sources, it has extended its shutdown of its Shanghai factory for at least another day. Of course, it has been shut down since Monday due to the lockdown in the city, but Tesla shares shrugging that off today, still up about 0.6% before the bell, Anna.
Now coming up on the program, Kaylee, Skylar Montgomery-Koning, TS Lombard Senior Global Macro Strategist. We will talk about what is happening in these markets, the significance of the weaker oil price, where that leaves equities, where it leaves bonds, and the growth outlook. We'll also talk to Anne-Sophie Corbeau, Global Research Scholar at the Center on Global Energy Policy at Columbia University. So many interesting angles on the energy story, including, of course, the SPR release. We'll start with that. This is Bloomberg.
When you think space, you probably think one space agency that travels under the radar is ESA, which is surprising considering what the European Space Agency has achieved and how vital it is to the global space industry.
We've collaborated with pretty much everybody who is involved in space exploration.
But ESA wants to be a leading force in furthering humanity's mission into space.
Commander Ground, do you copy? Copy.
If we want to have successful human missions to Mars, we are going to have to learn to live and work off-world in a different way. The place where we are going to learn to do that is on the moon.
Can ESA help humanity take its next giant leap?
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The jobs report last month beat estimates.
We have a very tight labor market. It is pretty clear.
Historic recovery in our labor market.
One of the best labor markets in a generation.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
More people are coming into the labor force. It's going to decelerate the wage gains. Is that good?
As the Fed looks to contain inflation, and it's really important that the jobs recovery continues.
The March Jobs Report, Friday on Bloomberg Television and Radio.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Lisa Abramowitz and Kaylee Lines in New York. Matt Miller is off today. I think he'd like this chart, though. This shows inflation across parts of the Eurozone. This is France and Italy, not because they're the highest numbers in terms of inflation. I've seen Lithuanian inflation up at 15%, I think, already. But this is just interesting because this is the data that broke today, but more additions, if you like, to that picture of higher inflation across the Eurozone. Christine Aquino, Bloomberg Markets Editor, joins us with her perspective. Christine, this data then just adding to that pressure, we understand, on the ECB to try and do something about this. But there's a lot of policy normalization to go before we get rate hikes from the ECB, isn't there? I mean, we're talking about pressure on the ECB to do something, but the market's not pricing in hikes until much later on this year.
Well, and yeah, I think we did see some movement on the pricing front this year. I know that they are now seeing about 100 basis points of rate hikes for the ECB over the next year. So even if it's not necessarily a 2022 story, it could be something that plays out in 2023. And remember also that traders are now seeing the end of the ECB negative rate era slightly earlier this year in October rather than December. So the direction of travel in terms of market expectations is definitely for the ECB to really kick-start that normalization process and get a move on when it comes to rate hikes. But as you mentioned, they're not even finished winding down their asset purchases just yet. And so that really raises the pressure on them to start signaling the end of that and moving on to the rates conversation.
Well, and of course, the Fed here in the U.S., Christine, has signaled they're going to move even more aggressively. They're already moving, and yet treasuries aren't hit as hard as bonds in Europe. Why?
Well, Kaylee, I think a few reasons there. A little bit of confusion over, the impact of the inflation story, the war in Ukraine, and what that's doing to commodities, and how that plays into the Fed equation. I think, the best explanation that I've seen for this is probably this idea that potentially a de-escalation in the Ukraine situation could slow the Fed down in its tightening pace. But then the question there is, there's a lot of reason already for the Fed to go with the tightening pace that they've indicated, even without that commodity story. We know that the labor market is quite hot in the U.S. We know that costs of goods beyond energy is rising, and that's something that the Fed really wants to address. And so there are these kind of jarring factors, competing factors here playing into the Treasury market. But ultimately, I think the direction of Fed rates is still very much higher, as we've heard from several policymakers.
Christine, thanks very much. Bloomberg's Christine Aquino joining us live on set here in London. And for more market analysis, check out the Markets Live blog, MLIV Go. That is the function to use on your Bloomberg terminal. This is Bloomberg.
Harcourts has stories about what they call black soot, caused by the manufacturing and consumption of these fuel products in the illegal refineries.
Oil theft, known as bunkering, and the refining of its spoils is worsening the damage from decades of fossil fuel exploitation, creating one of the world's most severe ecological disasters.
Our sacred forests, our homes, have to give way to oil wells, and no one gets much benefit.
Imagine a resident of Port Harcourt who inhales this soot every second in 24 hours, 7 days a week, 30 days in the month, and for years now, we are dying slowly but surely, and our lifespan is reducing every day.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This is Bloomberg Surveillance Early Edition. I'm Kaylee Lines with Lisa Abramowitz in New York and Anna Edwards in London. Now keeping you up to date with news from around the world, here's the first word. Another big payday for JP Morgan CEO Jamie Dimon. He just received almost $56 million of JP Morgan stock before taxes. It comes from an incentive program the bank valued at less than half that just 3 years ago. The latest windfall was helped by surging business during the pandemic. Apple is exploring new sources of the memory chips that go into its iPhones. Bloomberg has learned that potentially includes its first Chinese supplier. A production disruption at one of Apple's key Japanese partners exposed the risks to its global supply. And the chair of the SEC is downplaying speculation that there could be a deal to keep 200 Chinese companies from losing their U.S. listings. Gary Gensler signaled that only total compliance with U.S. audit inspections will allow them to keep trading on American markets. And Lisa, it's so funny. Just a few months ago, we were talking about Chinese pressure for Chinese companies to delist from the U.S. Now it seems the U.S. may be the one to force that hand.
Perhaps just trying to put imminence on these talks to get to some sort of resolution, as we do hear that those negotiations are ongoing.
Yeah, it looks as if it could be something that's a long time in the making. He's looking a couple of years out in these latest comments from Gary Gensler. We'll keep monitoring that. Skylar Montgomery-Koning from TS Lombard. Up next, this is Bloomberg.
It's almost the end of the year, but Bali is still quiet and empty.
I am here in Kuta Legian, one of the main walking streets here that is used to be a tourist spot for beach, dining, shopping. But many shops here are still closed. Most of the outlets are either for rent or for sale as they have run out of business.
Saya kerjanya di sini udah lama, udah ada 10 tahunan di sini kerja. Masih sepi sih, nggak kayak dulu. Kalau dulu kan rame, sekarang ya ada 1-2 itu ada. Tapi nggak kayak dulu. Kalau dulu rame sekali. Sekarang paling dapat jualan ya 100, 120 gitu. 200 ya. Kalau dulu sih ya nyampe dah 1 juta, 1,5 tuh nyampe dapat jualan. Bisa sampai 2 juta dulu. Sekarang nggak pernah lagi dapat segitu. Sama aja. Belum ada turis ke Bali. Masih ya domestik aja.
While Bali has reopened its borders for foreign tourists since October, they're still not coming in. Many international airlines are yet to reinstate their direct flight to the island. Balinese people here really hope they can see more people from Australia, China, and Europe to come visit next year.
Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
It's a great question.
Great question.
Great question.
Great question.
Great question. That's going to be the best question I get all night. I'm glad you asked that.
Bloomberg Television. Top experts. Great questions. However you get your news.
This is Bloomberg Daybreak with Lee.
On Bloomberg Radio.
Welcome to Daybreak Australia. This is Bloomberg Technology. This is Bloomberg Green.
On TV, radio, and the web. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. Here's what you need to know. The Biden administration is weighing a massive release of oil from U.S. reserves to fight inflation. Bloomberg's learned 1 million barrels of oil a day may be released for months for up to 180 million barrels. President Biden is set to speak on efforts to reduce energy prices later today. OPEC Plus isn't expected to help much on that front. The cartel and its allies are expected to rebuff calls to pump more oil. Member nations are again likely to stick to a schedule of gradual oil output increases. And in France, inflation is running faster than expected. Consumer prices rose 5.1% in March from a year ago. And in Italy, inflation surged to 7%, the highest in 3 decades, as energy prices continue to rise following Russia's invasion of Ukraine. The ramp up in inflation is putting pressure on the ECB to normalize policy and eventually raise interest rates. I'm Anna Edwards in London with Lisa Abramowitz and Kaylee Lyons in New York. Matt Miller is out today. The big focus then for markets is on energy, and a little bit of respite today then, Lisa, from higher oil prices because of what we expect to hear from the U.S. administration later.
Which really brings us to where we are now and what took us there. In other words, this oil shock, this stagflationary shock that people were looking at, why we're getting a reprieve, a little bit of an uptick in the S&P, futures up about 0.1%, 46.02. Why? It's because perhaps we could lower the price of gasoline in the United States, lower the price of oil with that incredible release, which would be the biggest ever. You're seeing 10-year yields come off a little bit, 2.336%, down about a basis point. But just to give you perspective, this has been the biggest biggest quarterly rise in 10-year yields going back to 2016, biggest quarterly rise in 2-year yields going back to 1984. Just to give you perspective, and crude off by 5.6% traded on the NYMEX in the face of what we're seeing with this potential oil reserve release in the dollar. A little bit of strength, perhaps, Kaylee, because people view this as a positive for economic growth, but really it's not a significant move, and how much staying power this has, given that it does not solve the structural problems, remains to be seen.
Yeah, that's a really good point, Lisa. And when I'm looking at pre-market trading, I see that a lot of the movement is actually tied to what we're seeing in oil. With prices going down, that means energy stocks are being dragged down as well. Devon Energy is down 2.5%. Exxon is down by about 2.1%. But on the flip side of that, beneficiaries of potentially lower oil prices, therefore lower fuel prices, that would be the airlines. And you are seeing those moving to the upside. United's only up about 0.4%. American, though, higher by a little more than a full percentage point, Anna.
And Kaylee, what we're seeing here on European equity markets then is a little bit of a move lower for European stocks. We started out in positive territory. The move lower in energy prices clearly adding to some appetite for risk appetite in the early part of the European session, but that has waned a little bit, and we're just moving a little lower on the stocks Europe at 600. Brent crude moving down by just over 5%. To Lisa's point, I spoke to the CEO of a Spanish energy business, a refining business earlier on today, and he was absolutely saying, look, this is not going to change the long-term fundamentals, the mismatch of supply and demand, but yes, it does have an impact in the short term, and we certainly see that here with that move of 5% in Brent crude. Kaylee, you were mentioning moves higher in aviation stocks pre-market in the US. That's certainly a theme that we've seen here in Europe. This is Wizz Air, of course, very exposed to the Eastern European business as well, to the Eastern European market, and that particular stock up by 2.5% this morning. H&M really in focus as a result of Russia as well, and this is because this company was growing really fast in Russia. It was also a source of profitability. They've had to close their stores there, and the numbers today disappointing the market. With an eye on Russia, let us recap where we are on Russian stocks. A bit of normalization taking place on the Russian markets, not all normal by any stretch, because still foreign investors cannot sell stocks there. But this is the picture as we find it now, up by 5.6% on the Russian stock market. We have local investors now able to short stocks, and we have a full trading day. That's the first time we've been able to say that since the invasion. This is the dollar down, the ruble up. The ruble continues to make a little bit of ground, as it has been doing over recent sessions, in fact, up by around 2%. Interesting to see the Germans say that the Russians are stepping back from calling for ruble payments for their gas. We'll see where that develops. Kaylee?
All right, Anna, well, let's get back to the monetary policy story here in the U.S. We spoke with Richmond Fed President Tom Barkin in an exclusive interview yesterday and asked whether he'd be open to a 50 basis point hike in May. Take a listen.
I'm open to it. I think the question, and we'll make this decision when we get to the meeting in May, is how strong does the economy still look in terms of its ability to take rate increases, and how high is inflation persisting? So I'm looking at both of those, and we'll make our call in May.
Joining us now is Skylar Montgomery-Koenig, TS Lombard Senior Global Macro Strategist. So, Skylar, seems like the drumbeat is toward 50 basis points in May. The market expects it's going to go far beyond that, 200 basis points more in tightening just this year alone. If you had to put odds on a soft landing or on a recession by the end of next year, which one is in favor?
I mean, it depends on what economy you're looking at for sure, but our base case for the U.S. is that we'll probably get a soft landing. And you know, the government bond sell-off has been remarkable, and that's because of the macro backdrop, right? So you've got developed market central banks aggressively tightening, heightened geopolitical risk is here to stay, and that knock-on effect, as you say, is a deteriorating growth inflation mix, and that's, you know, very worrying for risk assets, especially worrying because it affects the correlation between bonds and equities. But, you know, we're still at very, very decent growth numbers in the U.S. We're coming down to normalization. But if you think about kind of 2.5% year-on-year growth in the U.S., for a normal cycle, that's pretty good. And we don't think that the Fed will go so far as to put us past that point of being worried about it. You know, people are making quite a lot of noise about the fact that the 2-10s curve is inverted. But, you know, we've done quite a lot of analysis about what curves you should actually be looking at and whether or not, you know, it's just kind of signaling the inflation backdrop rather than signaling the fact that a recession is coming. And we think it's more of a reflection of the inflation backdrop, and not all curves are inverting. And so, you know, for us, I think it's more likely that you see a soft landing and you see kind of, you know, growth isn't materially hit in the U.S. by the Russia-Ukraine situation. It is definitely more of a worry for other markets, though, including Europe.
Skylar, is it a better outcome for U.S. equity markets to see profit margins increase, to see earnings come in hot, or the opposite, considering the fact that the Federal Reserve doesn't want to see them passing along all those price increases right now to consumers? They don't want to see the pricing power that leads to something more akin to an inflationary spiral.
Yeah, I mean, I would say there's a very, very big difference in the type of inflation when you think about that kind of thing, right? So the Russia-Ukraine situation and the effect that it's having on energy prices. And so we think that it's going to be a protracted situation. So you're going to get energy prices higher for longer. That is a supply shock. That is bad for equity markets. It's bad for the economy globally because it's the supply bit of the equation that's forcing inflation up. And that's very worrying because it means when you pass on price increases, it doesn't have the effect of, you know, there's more growth, and so people are able to spend more and they take those price increases. Whereas if it's a demand shock, you know, it's because people are demanding more. You can raise prices, and that's what we saw, you know, immediately post-COVID is you had huge margin expansion, equities are rising, you had stuff like shrinkflation and that kind of thing. but you had companies able to put higher prices on stuff because people were willing to accept it because the demand backdrop was good. And obviously different countries had different variations of that. So the US was much more demand driven than say the UK, which was more of a supply shock. And so the longer this crisis goes on, the more you shift that supply shock worries. And yes, it's hard. It'll be hard to see if we get more supply shocks in that way, further margin expansion, further equity upside as a result of that. And so it's definitely more of a worrying mix as the longer it goes on.
Skylar, good morning. In terms of the Eurozone economy, how do you see this playing out? Do you expect to see stagflation in full or just some sort of stagflationary impulse? The ECB rejects the suggestions that we'll see a recession in the Eurozone. That's not what their forecasts tell them, but one guest I spoke to this morning was suggesting that's where the Eurozone economy would be in the second half of this year. What is your expectation for the Eurozone?
Yeah, so if you look at the numbers on Bloomberg in terms of consensus, dispersion is massive. The lowest number consensus forecast that you get for GDP for 2022 is 2.2%, and the highest, I think, is still somewhere above 5%, which just seems completely unreasonable. The ECB is, similarly behind the curve. At the March meeting, they downgraded 2022 growth forecast to 0.5% rather than 3.7%. And that still seems very high for us. So we're more around the 1.2% target, and we're well below consensus. And I think there's definitely a very good reason about that. There's no doubt that the ECB is worried about widening rate differentials to U.S. weigh on the currency. They're worried about causing further inflation, and that creates a self-reinforcing cycle. But, we also think the ECB is very data dependent. And so as you start to see the economy get hit by the higher energy prices, the outlook was already deteriorating before Russia-Ukraine. And the situation in terms of energy prices just makes that so much worse. Everyone knows now that they get 40% of their natural gas from Russia-Ukraine, but it's really starting to hurt, and you're not seeing it yet in the growth data. But as our European economist, Davide Oneglia, has said, you're starting to see it in the confidence data. And so the confidence data that we've gotten recently, you could compare it to the confidence data you were seeing in COVID. And so while we don't expect a recession, our confidence bands are so large around that 1.2% that it's worryingly so close to a recession. So definitely a higher risk than even a month ago.
Skylar Montgomery Koenig, I think a lot of people would agree with you, of TS Lombard, Senior Global Macro Strategist. Thank you so much for being with us. Coming up, a really important conversation on oil, on energy, and Sophie Corbeau, Global Research Scholar at the Center on Global Energy Policy at Columbia University, will be joining to talk about the possible oil reserve release and much more. This is Bloomberg.
What's happening on Wall Street?
It's the basic law of economics.
The Fed is telling us this is transitory.
Need to catch up?
This is Bloomberg Wall Street Week. I'm David Weston.
We've got the information and insights.
David, you just hit the nail right on the head.
From businesses most influential and instrumental.
And that's the way you run good risk management.
But we need to invest in our systems.
Bloomberg Wall Street Week premieres Friday with replays all weekend on Bloomberg Television and Radio.
I think what we've seen during this period of time is that
communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kaylee Lines in New York. Now, oil has tumbled as the US weighs releasing reserves again to cool prices. Joining us now for more is Anne-Sophie Corbeau, Global Research Scholar at the Center on Global Energy Policy at Columbia University. Anne-Sophie, thank you very much for joining us. Now, your specialism is gas, and we certainly want to get to your expertise on gas, but expected today to an effective. This is incredibly important, the relationship with Russia. If I could just start on the messaging you take away, though, from what we're hearing from the Biden administration. They're expected today to announce a big release from the strategic petroleum reserves. What kind of signal will this send to the broad energy complex, do you think, Anne-Sophie?
I think they are signaling that the US is ready to act. And, releasing the strategic oil reserves is not something that you do every day. This is not something which is happening on an usual basis. But, the markets, the oil markets remain fundamentally very tight. So, this is a problem. And we are going to continue to see the tightness with potentially prices remaining at above $100 per barrel for quite a sustained amount of time.
Okay, and thinking about where we are on the gas story then here in Europe, Anne-Sophie, we obviously have been, Europe has been already very vocal about its need to reduce reliance on Russian gas imports. All the measures we've heard so far, whether that's LNG coming from the United States, whether that's Qatar looking to send some LNG to Europe, or at least the Europeans asking for that to take place, are you seeing anything that's going to make a material difference so far as to how Europe replaces that Russian gas?
First of all, this amount of Russian gas is really very important. It's about 40% of what the European Union is importing right now. It's not something that you can replace overnight. The European Commission report, the Repower EU that they released about a month ago, was calling for a reduction of 2/3 of these imports by the end of the year. In my opinion, this is extremely difficult to achieve. What we have seen so far is really looking at the supply side and how we can get supply from the different parts of the market, from the pipeline suppliers, but also from the LNG suppliers. I have not seen a lot of talks about reducing demand. In 1973, when there was the oil shock, I think everybody was urged to reduce its consumption. The governments there are talks about, you should reduce your consumption. And it's not only about gas, by the way. Every single kilowatt hours of energy counts. But they are not like messages hammered every day. You need to reduce your consumption. It's very, very important. No, what we see in terms of measures are, prices being capped in certain number of countries in order to protect consumers. And I think governments are worried about having a yellow vest movement. So they are really trying to protect all the consumers because, as you said before, there is a rise in energy prices. This is triggering a rise in inflation. This is also going to trigger some problems down the line in terms of food supplies. But what I see is that all the attention has been given to securing additional supplies. There has been talks with Qatar, there have been talks with the United States, but we need to act on both sides. We need to act on demand and on supply as well.
Okay, so maybe shifting focus a little bit to the other end of that balance, Anne-Sophie. I'm wondering as well, in terms of supply, how much of the issue relies on literally just the supply being available, of other countries having the capacity, the excess to send to Europe, and how much of a problem the existing infrastructure is, the ability for Europe to actually take in LNG at export terminals, for example?
That's an excellent question. Both problems exist. So first of all, Europe has never been a key market in the global LNG market. Asia is a key market. Asia attracts the LNG. Europe is a balancing market which can basically absorb the surplus when the markets are loose and can send, the gas, the LNG away when the markets are very tight. It has always worked like that. Think about 2020, all the surplus came back to Europe. Think about Fukushima. Europe sent LNG to Japan. So this is exactly how it has worked before. Now Europe is signaling, hey, I need LNG now. And indeed, the prices are much higher, so the LNG is coming to Europe. But Asia is still there. Asia still represents the bulk of global LNG demand. And we have countries which, unfortunately, can't afford to buy this LNG. This is Pakistan and Bangladesh. But we have other countries like China where LNG demand has been growing every single year. So how are they going to react to that? This is a key question. I mean, whether countries would be willing, like Japan, to maybe divert some LNG cargoes, but Japan made it very clear. It is not at the expense of the security of supply.
We've certainly seen Qatar talking about how their gas already has a home. Just quickly then, Anne-Sophie, can I get your response to the German plan, stage one of a three-part plan to keep an eye on, at least in the first stages, gas consumption? Are we going to possibly enter a stage of rationing of energy supplies as we go into the winter across Europe, or can measures be taken to avoid that?
I mean, it's again, a question of we need to reduce our demand right now. I mean, right now it was just an early warning. What is important is what is going to happen next. I mean, there is this kind of balance between, okay, we are looking at what Russia may be able to do or may want to do, but at the same time, we are continuing to import gas from Russia. And the flows have been relatively constant so far. So there is some sort of, ambiguity between we want to reduce our consumption from Russian gas. However, at the same time, we are still importing a lot because right now it's very difficult to secure additional supplies from other sources. This is a key problem.
All right, we have to leave it there, but thank you so much for your insight, Anne-Sophie Corbeau, Global Research Scholar at the Center on Global Energy Policy at Columbia University. Now we want to get the latest in crypto news. Bitcoin's rapid rally over the past few weeks has erased its losses for the year, but equity investors have yet to pile back into crypto-related stocks with the same conviction. Since hitting a 6-month low in late January, Bitcoin prices have jumped in March. Meanwhile, the Millennium Bitcoin Exposure Index, which tracks stocks with exposure to cryptocurrencies, including Bright Blockchain, Galaxy Digital, that remains lower for 2022. Crypto mining firms have been among the hardest hit. Steep, sudden price swings, not uncommon in the crypto space, but sharp declines in value, like the one seen in Bitcoin to begin the year, still create headaches for these stocks. While Bitcoin's recent rebound has erased some of the pressures, the run-up in energy prices over the past month as a result of the war in Ukraine is likely to drive up operating expenses for the miners that need to consume large amounts of electricity in order to run their mining rigs. And for more on the world of decentralized finance, make sure to tune into Bloomberg Crypto every Tuesday at 1 p.m. New York time with myself and Matt Miller. This is Bloomberg.
The Delhi airport, and behind me you can see SpiceJet 737 MAX aircraft. SpiceJet Chairman Ajay Singh earlier today said that Boeing is going to compensate SpiceJet in form of cash and aircraft. Celebration happening at the Gwalior airport. As you can see, they've literally rolled down the red carpet for SpiceJet Chairman Ajay Singh. there are balloons, there are flowers. This is a big deal for SpiceJet because it is the only Indian operator of Boeing 737 MAX planes currently.
Front Row, exclusive interviews with the most influential figures in finance. Lloyd Blankfein.
Deflation is a terrible thing. Inflation you could tolerate.
Kathy Wood.
Tesla will be in the pole position to dominate.
Jeremy Grantham.
We've had a very, very abnormal honeymoon Goldilocks period.
First available on the Bloomberg Terminal, then on Bloomberg Television and Bloomberg.com. Front Row, the best seats in the house for business's greatest minds.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Kaylee Lines in New York. Joining us now, Tom Keene, co-anchor of Bloomberg Surveillance. And Tom, you bring us, as you often do, your single best chart. And I know your single best chart today is a long view on US GDP. What have you concluded?
Well, it's a long view of a statistic that goes back to 1947 when we started counting the beans. And this is from before the financial crisis, 2006. And this is the animal spirit, the nominal GDP. Real GDP plus inflation of the United States of America. And I'm sorry, this is a victory lap for the institutional elites who said in the middle of COVID, all we can do is a fiscal response with a central bank that makes it work. Down we go off an established trend. We've come back with a vengeance. And of course, the real question here is the now what of it, given the price of all this fiscal expense, which is the inflation we're living. But it's a great chart of getting back to trend, exceeding trend, and now what forward for the nation.
Well, and of course, that same inflation exacerbated by the conflict in Ukraine, Tom, and I know you have a great guest to speak with about that later on today.
Well, we'll talk to Ambassador Haas. Richard Haas will join us. He's all fired up. A great, really intelligent essay, frankly, off his book that was my book of the summer one year, Kaylee, and it is about American overreach, and we'll discuss that with Richard Haas. But I really want to emphasize, Kaylee, there's an underplaying in the media right now of the boom that we're in is a demand boom. Yes, it's about the war. Yes, it's about hydrocarbons, et cetera. But a lot of this is just demand as we come out of COVID.
Yeah, and the question, I guess, is when do we start to see demand destruction kick in with these higher prices consumers are facing? Tom
See,
Keene,
you must be hanging out with Lisa.
I know.
You gotta spend less time with Abramowitz. That's
she
all
was
there
on the
is to
show
it.
with me the last 2 days.
I
It
know.
influences me.
It's just a massive influence.
All right, well, I know you're looking forward to joining Lisa and John in just a few minutes'
I
time.
am.
Tom
I am.
Keene, co-anchor of Bloomberg Surveillance, thank you very much for joining us. Now a look at what else we are watching today. I have my eye on oil, Anna, down pretty hard. WTI is down about 5.7 percentage points at this point. On the one hand, you have OPEC Plus probably not going to diverge from its course to add 400,000 barrels a day in oil on the market when it makes its decision for next month. At the same time, you have the Biden administration possibly considering a massive, massive release from the Strategic Petroleum Reserve. When I say massive, we are talking potentially 180 million barrels of oil. My question is really, Anna, how much does that actually make a difference in this market? We've seen them tap the SPR already twice in just a couple of months. Didn't actually really influence prices at the pump.
Yeah. Typically has a short-term impact, doesn't it? And if the underlying fundamentals of supply and demand don't change, then that's where it ends. But this is big, and if it is designed to drip feed over day after day after day, then perhaps it has a different dynamic to it, Kaylee. I'm interested in the Chinese growth story right now. Tom was talking about rebounds coming out of COVID. Well, this is a very different story, isn't it, over in China? We had PMI data out of China just in the last 24 hours that looked pretty weak. An economy, according to the PMI data, a danger of contraction there. And this was even before Shanghai went into lockdown. What policy support will we get from the monetary, from the fiscal side? They're also talking about building up a fund to backstop financial services. A lot to think about on China. That is it, though, for the early edition. Bloomberg Surveillance still ahead. This is Bloomberg.
companies now, they're getting hundreds, maybe even thousands of applications. So softwares come in to automate the process.
You want to write your resume for robots, not for humans. The only job your resume has is to be comprehensible to the software that is reading it, because that software or robot is going to decide whether or not a human ever gets their eyes on it.
These things are programmed by a certain segment of the population that might not be totally inclusive or not be fully aware.
Concerns about how this technology could exacerbate discrimination. For the FTC, I think foremost, the FTC needs to be making sure that we're fully understanding this technology.
We don't trust companies to self-regulate when it comes to pollution. We don't trust them to self-regulate when it comes to workplace comp. Why on earth would we trust them to self-regulate AI?
It's always hard to predict what the Fed's going to do. It's even harder in an environment like this.
I still don't believe the Fed intends to cause any sort of economic recession like over-tightening.
It's remarkable how flat the curve is so early in the rate hiking cycle.
It's going to be really difficult for the Fed to hike rates aggressively.
You have to choose between recession or the anchoring inflation expectation. You cannot have a soft land.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Wrapping up Q1 from New York City for our audience worldwide. Good morning, good morning. This is Bloomberg Surveillance live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Futures up 0.1%. TK, the focus this morning on crude.
Now, the focus this morning maybe is on getting through the second quarter as well, and part of that will be the price of commodities in general, and of course on crude oil. The president to do some strategic planning here. I really wonder, John, I got to be honest, I'm skeptical he can move the price.
Some monster strategic planning, Tom. The team at Bloomberg down in Washington, D.C. reporting they could release as much as 180 million barrels of crude.
It'll go in. It's a world price. It will go in, John. It will make an effect, and we've seen it. You know, we can do the data check right now. Brent crude, 101 a barrel. But what will it do a week from now? What will it do a month from now, John, given the 24-hour news in Ukraine? And, John, I'm going to say this till I'm blue in the face this morning. It's not going to be April Fool's. I'm going to say it's a demand economy. We have a boom economy. COVID deaths, John, are nearing 699. That is a triumph, and that shows the recovery of the American economy, and that means oil up.
Onto payrolls on Friday. Lisa, we've seen this movie a few times before, a reserve release. Not on this scale, though. Will it make a difference?
So let's talk about the scale. It's 100 million barrels. That would be the maximum amount total if they did this, millions of barrels of release every day. That's about 1/3 of the entire pool of reserves going into the driving season. So there is a question about what this does down the line, especially if you have to replenish those reserves, leading some to speculate it could actually push prices up higher in the longer term.
So what's left to do? The president speaking a little bit later this morning. The oil execs hold in front of Congress next week. What can they do?
What I want to hear, honestly, is some sort of cohesive plan of what they're working with the oil majors will be, what they're going to be doing with the shale producers, what their cohesive plan to really echo what Eric Moniz was saying yesterday, that incorporates some of the reduction in the reliance on fossil fuels while also supporting the fossil fuel industry, given that this transition is complicated and given the fact they still need to rely on it.
We keep saying this, Tom. You talk up the economy, I'm with you. But at the same time, it's hard to reconcile what you say with how people feel about it. Gallup out with a new poll this week. The most important problem facing the U.S. today, inflation, the cost of living. gas prices.
John, we brought home a $19 chicken, a whole chicken last night, an uncooked chicken, $19. That's a new statistic in the Keene household, and everybody's got 45 stories like that. What I would emphasize, John, is inflation is front and center, and you nailed it yesterday with Greg Valliere when you grilled him on Biden as one or two terms. Valliere sort of hedged. He publishes this morning, Joe Biden, a one-term president.
A one-term president.
Because of inflation.
Tom, who's in the stable to step up and campaign?
Please, I'm not going to go there. Even Republican or Democrat who's in the stable, we'll sort that out. Maybe not Q2 starting tomorrow, but that's a Q3 question.
Let's round up Q1. Futures right now up 0.1% on the S&P 500. On the month on the S&P, up more than 5%. And what a month it's been, even with a major move in the bond market. The two-year yield up 85 basis points in March alone. 10s right now coming back down 2 basis points to 230, 234. And crude, there's the move, Lisa, down 6%, 101.21.
And how much are we baking in? And this is why I really want to hear what OPEC Plus has to say today. They are meeting on output starting in about an hour. How much do they stick to their conservative reservations, their conservative increase in output as they continue to talk about some of the concerns in a market still beset with pandemic-era restrictions in travel and some of the other issues that have plagued the market? What we are seeing, just to give you some perspective, I want to take a look at that strategic petroleum reserve that the U.S. is tapping to try to cushion the blow here of the loss of some of the Russian supplies from the market. There are about 568 million barrels within the Strategic Petroleum Reserve. That puts into perspective just how big 100 million barrels really would be and what position that leaves the U.S. at a time where a lot of these issues are structural in terms of how tight the oil market is. At 8:30 a.m., we get a slew of U.S. data, including initial jobless claims, as well as February personal income and spending. I want to hear what we hear out of spending. How much does real spending decline? We have seen the expectation of a decline in real spending. If we start to get more of this, can we start to talk demand destruction from inflation? Can we talk about, yes, Tom, I hear your point about the resilience of the U.S. economy. At what point does that get eroded by some of this loss in buying power by the consumer? And at 1:30 p.m., we'll hear the details on that 180 million barrel release. President Biden speaking about how they plan to do this at a time when gasoline prices still around the highest on record at about $4.24. How much can they really do further? And what are they planning? And John, this is what I want to hear. What are they planning over the longer term? Because this does not solve all the problems. All it does is sort of put a Band-Aid over a moment that is very tenuous.
Bremo, thank you. Team coverage starts right now with Bloomberg's Jack Fitzpatrick down in Washington, Maria Tadeo in Budapest, Hungary. Jack, let's start right here. The Strategic Petroleum Reserve and this administration, according to the team down in D.C., considering a monster release. What are the details that we're aware of?
The reporting so far has been they're discussing about roughly 1 million barrels a day, and the maximum number discussed would be up to about 180 million barrels total. That's a significant amount. Of course, as Lisa said, pretty much by definition, the Strategic Petroleum Reserve is a Band-Aid. There's no way for them to use this to address the major structural issues about oil and gas availability worldwide. But in the context of that reserve, it would be a historically large release if it did get up to that 180 million or so. They've got 568 million in the reserve right now, so it'd be a significant chunk of what they've got built up.
The move in hydrocarbons is, of course, a move within democracies and other forms of government. Maria Tadeo comes to us from Hungary today. Mr. Orban, almost with a Putin tenure, 4 years and then 12 years. I think that adds up to 16 years, Maria Tadeo. This guy is controversial. How does the illiberal Orban deal with the oil prices Jack is talking about?
Well, Tom, by the way, he's hoping for another term on Sunday. That's why we're here. It's the general elections for Viktor Orban, who, as you know, I mean, you've seen him in America. He's been portrayed as the man that protects Christian and family values in Europe. Of course, others may disagree and use that word that you used. He's an illiberal politician. But, you know, Tom, how does he deal with oil? Well, what he says is the way to deal with this is by staying out of this war. And to me, yesterday, there were two things that really struck me, Tom. One is that you can still watch Russian TV in this country. Remember, the satellite has been taken off in Europe. And then two, of course, that this is presented as freedom for Hungary or going to war. This is the line that Viktor Orban pursues. We should not get involved in this. We should not sanction Russia too hard. He's against an energy embargo. He is helping refugees. Of course, he should. But you're starting to see the real cracks in Central and Eastern Europe. Remember, Poland, Hungary, these are countries that normally work together. Right now, they're not even on speaking terms.
Maria, we've seen cracks throughout the European Union as we try to deal with the Russia situation, in particular what Germany does with their imports of natural gas. Yesterday, there was a lot of discussion about possibly having gas holidays, people actually just reducing their consumption. What's the latest on that? What's the pushback in terms of consumers to such a proposal?
Look, I think it would be very hard, and if anything, what we're seeing now, and not just in Germany, but pretty much across Europe, is that, of course, this hurts drivers, it hurts the middle class, and there is a feeling now that everything is becoming very, very expensive. I mean, you feel it in all of your bills, and there is real pushback across the European Union. Not just Germany, by the way. I would point to Spain, now has inflation double digits, and the Prime Minister has a protest every day, pretty much, in the capital of Madrid. So a lot of this, of course, is beginning to bite in a very real way.
Jack, to get our morning started, we need you to get out the Fitzpatrick calendar and give us a read on when the Democrats finally address a one- or two-term Joe Biden. Greg Valliere says it's hugely tangible. He's a one-term president. What part of 2022 does this become part of your focus?
There's not a lot of focus right now on Biden's reelection prospects because there are so many Democrats worried about their own prospects or Democrats who are retiring. It's looking tough for Democrats congressionally, but they're at least having relevant conversations that will play into the electoral success or failure congressionally and for the White House. That's why there's pressure to at least get back to some sort of, they're not calling it Build Back Better, but some sort of another legislative push to reduce prescription drug prices, some other major accomplishment they can cite, smaller than what they'd discussed before. But yeah, clearly talking to Democrats, there's not some sense that Biden is carrying them and that his polling numbers are helpful in any way. They really are a lot more concerned about their own polling numbers and their own struggles this November, though.
Hey, Jack, good to catch up. Jack Fitzpatrick and Maria Tadeo. The cost of the pump right now, Tom, $4.24 a gallon. That is your national average. And as you know, in places, it's a whole lot higher.
I asked my drivers, the Bentley's been in the shop. We can't get parts because of all the, the war in, London and shipping and that. And I've been in cars more, John, and I asked them the price. They're all up at $4.95.5.
Shall I make you feel better? Try $8 in the UK right now, Tom.
No. We'll discuss this, John. This
160, 170 pence a litre.
Europe's looking at Americans whining about this and going, you got to be kidding me.
Well, at the same time, Tom, we'll think about how much driving some Americans have to do outside of the tri-state area, outside of the West Coast, the middle of the country. That's some significant driving some Americans have to do just to get to work, Tom. So it's going to bite either way. It's biting everybody. But in Europe, they're going to face higher energy prices as well. They're dealing with that across the continent.
Do you think we're going to switch to smaller cars? I mean, that's a huge deal for Lisa when she's got to put the 18-foot Grumman on top.
Let me just explain that you actually are seeing signs of demand destruction with people buying fewer gallons of gas at the pump. There is some anecdotal data. So perhaps they're actually altering that massive.
Tom wants to know if people will drive smaller cars, Lisa.
No, that's not the American way. We've learned that time and time again. Let's be honest.
That's not going to work out again.
Maybe.
Electric?
Let's hope. Who knows?
Can we get demand destruction at Brandy Melville? Is that possible?
Is that costing you?
It's killing me. I need some demand destruction. Brandy Melville.
For TK this morning. The cost of fixing the Bentley. Good stuff. Futures up a tenth on the S&P, crude down by more than 6%, 101.10 on WTI from New York. This is Bloomberg.
Keeping you up to date with news from around the world. With the first word, I'm Lisa Mateo. The Biden administration is weighing a massive release of oil from U.S. reserves to fight inflation. Bloomberg's learned 1 million barrels of oil a day may be released for months, for up to 180 million barrels. President Biden is set to speak today on efforts to reduce energy prices. Meanwhile, OPEC and its allies are refusing to engage with the energy crisis triggered by the war in Ukraine. At its meeting today, the OPEC Plus coalition is expected to stick to its schedule of gradual oil output increases. That plan was reached last July and has been followed ever since. Saudi Arabia has prioritized its relationship with Russia, which co-leads the OPEC Plus alliance. The White House says that Russian President Vladimir Putin has been misinformed by his advisors about his military's performance in Ukraine. A spokeswoman says the same thing has happened regarding the impact of sanctions on the Russian economy. She said that's based on U.S. intelligence findings. Apple is exploring new sources of the memory chips that got into its iPhones. Now, Bloomberg has learned that potentially includes its first Chinese supplier. A production disruption at one of Apple's key Japanese partners exposed the risks to its global supply. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Lisa Mateo. This is Bloomberg.
has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The Indian city of Jamnagar is a money-making machine for Asia's richest man, Mukesh Ambani. His company Reliance has the world's biggest oil refinery complex here in the city. Jamnagar is also where Ambani is making his newest bet, a $10 billion investment in green energy. His ambition is closely aligned with the Indian government's plan to reach net zero emissions by 2070. But Ambani is not alone. India's second richest man, Gautam Adani, has committed $20 billion of investment over the next decade. But India's massive dependencies on fossil fuels have some environmental advocates questioning the realism and sincerity of those green ambitions and those of its two biggest billionaires.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
The jobs report last month beat estimates.
We have a very tight labor market. It is pretty clear.
Historic recovery in our labor market.
One of the best labor markets in a generation.
This Friday, Tom, John, Lisa, and Mike will bring you the data and analysis as the numbers cross the Bloomberg.
More people are coming into the labor force. It's going to decelerate the wage gains. Is that good?
As the Fed looks to contain inflation, it's really important that the jobs recovery continues.
The March Jobs Report, Friday on Bloomberg Television and Radio.
It's clear that removing accommodation is required, but how much and how aggressively accommodation should be removed, I think, is far more uncertain. That's not an argument for stalling the removal of accommodation, but I do think it suggests that a steady, deliberate approach for the path of policy will provide space to monitor developments there as they unfold.
That was Esther George, the Kansas City Fed president from New York City this morning. Good morning. Futures down by around about 0.02%. On the Dow Jones, Tom, that was for you. On the S&P 500,
Whoa,
we're up.
John,
We're up.
April Fools.
We're up. It's tomorrow.
That's tomorrow.
Up a tenth of 1%. Yields are down by a couple of basis points, 233. I said down on accident. I had to pivot. Euro dollar, 111. Crude is down by about 6%, 101.46. The Dow's now unchanged. Tom, dollar ruble 82. I don't know what kind of market that is anymore, but the Kremlin seems to think that the Europeans should pay for their gas in it. Ruble payment for gas won't change the terms for customers. The Kremlin out again this morning, Tom.
Okay,
prices,
we
volumes in
gotta stop
gas
here.
contracts won't be affected.
Where's this going? I mean, this is real
No
time.
idea.
This week, no one has a clue. Germany, Russia, payments, and flow of hydrocarbons, do they?
Tom, if I take a step back, get to 30,000 feet, I see a buyer that wants to buy gas and a seller that needs to sell gas. They're having this conversation about what to pay for that gas in, but ultimately, the Europeans still want to buy Russian gas, for now at least, and the Russians still want to sell it. So where's this going, Tom? You'd imagine it goes in the right direction. But hey, in war, who knows?
We'll see. A famous surveillance reset is March 31. John Farrow says this is when the year really starts, not the foolishness of 12/31 and the year outlooks. We reset with Marvin Lowe, State Street Global Senior Macro Strategist. Marvin, thrilled to have you on to reset in the second quarter. What is the distinction of your reset this morning?
I think it really, first and foremost, is around monetary policy. The first quarter was transformative. We know how badly bonds got battered. We have a much better sense of where the Fed wants to get, at least this year. And the term of trying to get to neutral quickly, I think, has been heard loud and clear in the market. So we're getting to neutral very, very quickly, pricing somewhere around a 2.25, 2.5 end of year Fed funds rate. And then we have to think about what next year looks like. And after getting through the first quarter, we can get a much better idea of how we want to approach 2023, because that's really where the inflation story goes, and that's really where this terminal rate, if you will, starts to come into focus.
Marvin, the year restarts, as Tom indicated. Everybody's talking about this restoration hardware call. RH, the CEO, talking about a sharp deceleration in consumer activity. What did you make of that?
You know what? I mean, certainly, he talked about everything in that call. So it was fascinating. It was wonderful.
You're being diplomatic.
To hear that perspective. Yeah. You never know what avenues we cross in life. But it does show that there is demand destruction that's occurring, and there is substitution that needs to happen. And it's an interesting demographic that they go after, where it's, there's a certain amount of wealth to it, but not necessarily the high-end wealth. And that's where a lot of these higher prices, when it comes to oil, when it comes to food, affects a group that should be able to ultimately get through this. And he's seeing demand destruction. So that's important to me, because that's really what the Fed needs to do in order to kind of get this forward inflation story in check.
Wait, hold on a second, Marvin. I'm not going to be as diplomatic. He threw the kitchen sink at a problem in the slowdown in their business, leaving some people to wonder, is it exactly as you say, which is some sort of slowdown in consumer demand, or is it an idiosyncratic problem with their business model and they're going to have to deal with? I don't need you to weigh in on what your view is on restoration hardware, but I just want to emphasize the fact that you're basically saying it's the idea of a slowdown in consumer appetite that you're starting to see elsewhere that's going to become the theme over the next quarter.
Yeah, no, I think that's something really to focus on, because that is what the Fed ultimately needs to do. Given that higher rates really will have no impact on energy, the lag between housing is going to be a while, and the food discussion is one that's going to take a while, and that's a big part of the increases month to month. So it is that consumer demand destruction, it is that service demand destruction that we have to get a sense of. In terms of how aggressive the Fed actually thinks it needs to be in 2023 around those topics.
Yeah, you're making jokes about this. John, I had the Modern Aviator flight desk for like $8,000, and it was too low. I couldn't get my legs under it. I had to send it back. It was
You're
terrible.
only saying that because you know I've got it. I can tell you lots of things about RH, Tom. World-class logistics.
Yeah,
I
they
order from
deliver
RH
like
because I know I'm going to get the delivery.
Yep.
I know it's going to arrive in a couple of weeks. If it's in stock, I'll see it next week. Questionable quality of the products, Tom.
Careful here, John.
I sent some stuff back recently. I'm just talking about my own personal experience. Unimpressed.
I am with you in that they're very entrepreneurial. They nailed the delivery, but some of the other stuff is a little suspect.
And then started to become like a lifestyle business, Tom.
Well,
with a restaurant in the shop, in a store.
Yeah, our guest is Marvin's going, why did I get up for this? Marvin, let's go to RH and move it forward. RH and others are looking at the new technology, Chewy in the tank the other day. Okay, it's about new technology and new habits from the pandemic. How do we adjust our equity portfolios for the fact that we're all going to use Amazon, all going to get boxes, and all these companies have to adapt and adjust to our pandemic habits?
Yeah, I mean, absolutely. I've liked the balance sheets and the growth profile of a lot of these disruptive tech companies, if you will, that you're talking about, Tom. And I do think that there is a longer lag time in order to see how innovative these companies really wind up becoming. So from a weighting perspective, if you're just buying the index, you're already getting increased exposure to those companies because they have performed well, obviously, the last several years, and they performed very well over the last several weeks. And I think it shows the strength in that model. Certainly you could take alpha and overweight some of those, but really looking at innovative technology, I think, is part of the discussion because, whether it's a longer duration play because slow growth reemerges, as the curve is saying, and or they have some competitive advantage in the market is shown year and year again.
Marvin Lowe, thank you for your patience and for the conversation too of State Street. Thank you very much. Just getting a headline out of Italy. Prime Minister Mario Draghi had a call with the Russian leader Vladimir Putin. Draghi said, Putin said, Tom, conditions for a ceasefire have not been met.
Yeah, well, that's the story forward. And I think the news, frankly, the last 24 hours has been really problematic, to say the least.
We've got to catch up with this man, Tom, Richard Haas, the president of the Council on Foreign Relations. That is coming up very, very shortly as we close out Q1 and really, in many ways, restart 2022. Futures up 0.1% on the S&P. Yields coming in a couple of basis points to 233 from New York City. This is Bloomberg.
When you think of cutting-edge technology at sea, you might be thinking of stuff like this. But there's an incoming revolution on the high seas that isn't quite as sexy, but could be significantly more impactful.
Container shipping is the key component of global trade. About 80 or 90% of all the world's goods are transported at sea at some point.
But there's a significant unseen cost to the modern era of global commerce.
About 3% of all the world's CO2 emissions come from shipping.
3% may not sound like a lot, but that's roughly comparable to the entire CO2 output of Germany. Since reducing trade isn't a likely option, what about a technological improvement to help reduce the emissions from these well-stocked maritime behemoths?
Crypto, you have a world of young people that want their own financial system and their own culture. And it is very powerful, and I'm a big believer in it.
We've got a fantastic guest coming up, so I'll keep this short and sweet. The equity market, as we close out Q1 of the month of March, the S&P positive by about 0.1% on the month, up by more than 5%. Even with this move in the bond market, two-year yields are up by 85 basis points. In the 140s to close out last month right